18. Yesterday was our math unit, and I stressed the importance of working on both sets of questions. Can't skip these. What's this? Oh, this is a promissory note. Oh, you remember how, I'll share with you guys. You remember how I was talking about if a tenant can't pay the full month's worth of rent, then don't take partial payment, because the same as collecting the full month's worth of rent in Florida, unless you can get them to sign a promissory note. So I don't know what this is. Oh, this is just their lease agreement. But they were like, okay, I don't know if I can make the rent on the first of the month for one of my rental properties. And I was like, okay, well, we give a one-time exception to the rule, but you have to sign a promissory note. So I was working on that, telling them the penalties and all that stuff. Anyhow, let's pull up those units, 14 and 18. And the good thing about this review, I'm going to go through every single one of these questions, every single math problem, step by step. So you guys, unless we already did it in class, we did a couple, not too many, but you had several to work on independently. But I won't skip any of these. We won't paraphrase. We need to know exactly how it works. Let's go through it together. All right. Obviously, we don't have to go through the first 4 questions, but we're going to start with question number 5. Another trick when going through math problems, specifically, if you look at the questions, if you read out the last sentence, it usually reveals the formula that is to be applied for that specific question. If you read the last sentence, what does it say? It says, what is the sales associate's what? Commission. So we know immediately what formula to apply, the sales commission formula. You could take out your handouts for each one of these questions, the formulas. Yes. Right. Did you grab it from online by any chance? Okay. All right. I printed out an extra copy, but I gave the extra copies to your fellow classmates. So you might have to follow along for now unless they can hook you up. And you do have access online. You do have access to all of these handouts. So you could print out as many copies as you like. If you have access to a printer. Unfortunately, I don't have a printer in this room. Sorry. I just don't. And this is going to be a temporary space. Next time, if you needed to come back and make up a class or whatever, we're probably not going to be here. We're probably going to be in, as I mentioned, we locked down that theater. It's going to be exciting. I'm so pumped up for that. It's hard to get excited from this position unless there's some new technology you can implement in the classroom. But a new environment with that type of ambiance is super cool, and I'm excited for that. But let me read out this question. A broker lists a motel for $1,450,000. A listing agreement specifies 6.5% sale commission for the first $600,000, 7% for the next $800,000 of that selling price, and 8% on anything over $1.4 million that you sell that motel for. The broker agrees to a 45-55 split if the property is sold by one of the broker's associates. The property is sold in-house, so the broker pays the associate involved in the transaction 55% of total commission. What is the sales associate's commission if they sell the motel for the listed sale price? This is step commissions. If you can recall, we talked about sales commission, and there were 2 calculations, straight or step. The formula remains the same for both, but this is step. How do I know? Because you're paid on different steps, levels, tiers of commission. You're not paid just 1% straight percentage, and then that's what you earn. So let's go through the details together. First of all, let's identify what you sold that motel for. The motel was sold for how much? $1,450,000. That was the sale price, correct? So we know that. We've established that. But they said within that sales price, you receive different percentage of commission based on tiers you hit, steps you hit. And they mentioned for the first $600,000 of that amount, you receive what percent? 6.5%. And when you do the math, tell me what you get. You get $39,000. You can do this math independently. You should have a calculator out, multiply by 0.065 or 6.5%. I don't like using the percentage symbol on the calculator. Because for whatever reason, it didn't work on whatever calculator I was using when I was in grade school. And I'm like, man, this crap doesn't work. I'm just going to use the decimal. But it forced me to use a decimal. And I'm thankful for that because it made math a lot easier. Don't rely on that percentage symbol. And then they said for the next 800,000, which do you hit? Do you sell the motel for at least $800,000 more? Add those two figures together. Yeah, we're still within that figure. And they said for that 800,000, you receive what, 7%? And when you do the math, you get 56,000. Okay, cool. Now this is where you got to pay attention. They said if you sell the motel for anything over 1.4 million, we know the motel was sell for 1,450,000, correct? But they said anything over 1.4 million. And obviously you did. You sold it for how much more? You sold it for $50,000 more. And they said on that $50,000, you're going to receive what, 8%? And when you do the math, you get what? $4,000? $4,000. You add these three figures together, this gives you the total commissions. Go ahead and tell me what the total commissions are. Because we're going to take those total commissions and plug it in over here. Because we have to do something with that total commission. What'd you get? 99,000? And they said of that 99,000, the associate, what's their split? 55%, correct? The associate gets 55%. So when you multiply, you get your result, which is 54,450. Is that right? You understand how we got this result? So we multiply, we got the total commission when we add those three figures together. But of that total commission, the associate receives 55%, and that gives you the associate's share of commission, how much they earn. And that would be answer B as in Bravo. Any questions here? Any questions? Did I lose anybody? All right, let's move on. Next question, 6. Read out the last sentence. What is the builder's percentage of loss? So we know it's the profit or loss formula. Immediately, we know what formula to apply. But I'll read out the entire question. A builder purchases a residential lot for $42,000, constructs a new house at a cost of $178,000. The builder later sells that property for $187,000. What is the builder's percentage of loss? We could take out that handout, profit or loss. And our first step is to calculate the rate of return. This is the formula. A times B equals C. Total times rate equals result or part. You take the total cost, which they don't just come out and tell us the total cost. What he paid for everything, land and construction. But they give us enough information to figure it out. The land is $42,000, is that right? Plus the construction, which is $178,000. But that gives you a total cost of $220,000, right? But he sold it for how much? $187,000. We know it's a loss right off the bat. Bought it for $220, sold it for $187. Go through your steps, slide and divide, right? Take $187,000 divided by $220,000. And tell me what you get. You get point what? Tell me if you got that number. You take 220. You don't have to include all the zeros, the 3 zeros at the end. 220 divided by 187. You get 0.85. which is how much percent? It's 85%. Essentially, what this means is he got 85% of his money back. Did he break even? No, fell short. 100% is breaking even. Look down here where it says loss calculation. You take 100%, which would have been breaking even. You subtract his rate of return, what percent he got back, and the actual loss, he fell short by how much percent? 15% loss. Does that match up with one of our choices? Be careful on your exam. On your exam, they will include 85% as one of your choices to confuse you, to throw you off. And hopefully you're prepared for that. Correct answer is B as in Bravo. All right, number 7. You bought a house in Citrus, Florida for $130,000, gave a deposit of $19,480, assumed a recorded mortgage of $90,520, and signed a new second mortgage and note for $20,000. What are the total state taxes due as a result of this transfer of property? We could take out our state taxes related to the finance and purchase of real property. This handout. And I can tell you based on the information provided, we're going to use all 3 calculations because there is a new loan and there is a transfer of a deed. So we're going to have to use all 3. Let's go through it. Is there a new loan? Yes. Of how much? What do they tell us? There's a new loan of what? Didn't they tell us there's a new second mortgage of how much? Of $20,000. $20,000. Is there any other new loan besides the new loan of $20,000? No. So from that, we know there's an intangible tax on that new loan specifically, only new loans. And what's that intangible tax? When you do the math, you get what? Go ahead and confirm. Take 20,000, multiply by 2 mils or 0.002, and you get 40 bucks. But anytime you have a new loan, if you remember, how many taxes do you pay on new loans? The tax on new loans and the tax on all loans, which include new and existing. So you take that $20,000, you have to plug it in to get taxed for the second time. So you take $20,000. But do we have any other loans involved in this transaction? Isn't there an assumed loan, an existing loan that's going to be assumed of how much? 90,520. But remember, now we're calculating a what type of tax? I'm pointing to it. A stamp tax. What do we know about stamp taxes? Any amount less than a $100 bill must be rounded up to $100. Is $20 less than a $100 bill? So it changes this amount, and that's the mistake that a lot of people make. Turns into 90,600. What you can do is make it a little bit easier for you. Now you can add these 2 figures together and you can multiply by this rate. 3.5 mils, 0.0035. And what do you get? 387 and 10 cents. Is that right? Can you check? Take 110,600. Multiply by 0.0035. 387.10?
Yep.
Okay. So from these 2, when you multiply, is what you get, 387.10. And do they mention transfer of a deed? Yes. And we have to pay taxes for transfer of a deed. And we need the purchase price. Luckily, in the question, we don't have to look for it. They tell us the purchase price is $130,000. They try to confuse us with that deposit, that down payment. We don't care. It's part of the purchase price, which they already shared with us. Loan plus your down payment equals the total purchase price, but they said the purchase price is $130,000. You multiply across and you get 910. Is that right? 910. When you add those 3 figures together, what's your total state taxes due as a result of this transfer of property? Is it 1,337.10?
Yep.
Is that what you got? Does that match up? Letter D as in Delta? Any questions here? Any questions? Okay. All right, number 8. A broker lists a property with an agreement to a 7% commission split as follows: 45% to listing broker, 55% to selling broker. A sales associate who works for the selling broker sells a property for $160,000. The associate's agreement with her employer calls for a 60% share of all commission she brings to the company. How much is due to the associate? It's the sales commission formula once again. And you take your total sale or sales, right? You multiply it by the rate of commission, and that equals your actual commission check, right? What is the sale? 100 and what? $160,000. And you multiply it by the rate of commission, which is 7%. When you do the math, you get 11,200. At least that's what I got. You can confirm this. 11,200. And then it's split between the listing and the selling broker. But they clearly tell us the associate is working for the selling broker. That's the side they want us to calculate for you. Multiply by 55%, and that gives you $6,160. But we're not done. That's for the brokerage. The associate gets 60% of that. You multiply by 60%, and you get your result, which is 3,696. Is that one of our choices? Correct answer is D as in Delta. You understand how we got this? Any questions here? This is an easy one. When it comes to like the sales commission, you don't need me to show you. It's quite simple. But let's move on. 9, a woman owned 3/8 of a property. She was paid $45,000 for her share of the proceeds from the sale of this property. Was the total selling price? So you have to work backwards to get the answer. And remember, we use ABC for that. ABC again. And what's the ABC formula? A is going to be the total of something times the rate of something equals result or part of something. So this is how we organize, but let's see how it works for this particular question. Do we know what the total is, the total selling price? No. That's what they're asking us for. So isn't that going to be our mystery? The total of something? Yes. But we know that look up here, 3/8 of that selling price, or in decimal form, 0.375, same difference, gave her what part? What was her part as a dollar figure? What did she make as her part? 45,000. So you see how we organize? And the only thing we're missing now is the total what she originally paid for it. What do? Keyword starts with an I. We're going to what? Isolate by itself one side of the equation. What mathematical symbol separates the equation? The equal symbol. So what do we have to get rid of? Exactly, the 0.37538. Exactly. How do you get rid of it? Slide and divide. Works every single time. So go ahead and take 45,000 divided by 0.375 and tell me what you get. What's the total? Yeah, if you do the math properly, you'll find out that the total equals $120,000, which is letter D as in Delta. ABC comes to the rescue again. Let's move on. Let's continue to question 10. We worked on 10. The correct answer was C as in Charlie. Number 11. A buyer is purchasing a house with a closing schedule for April 22nd, non-leap year. You see they tell us within the question if it's leap year, non-leap year. The annual property taxes, we know property taxes are annual, are $2,652. The sale contract states that the day of the closing belongs to the buyer, and they have to share that with us as well. Calculate the property tax proration using the 365-day method. They share all of that relevant data with us. We are going to pull up these prorating calculations, and this is proration of property taxes. unpaid property taxes. The first step always when doing a proration calculation, if you look up here, is to get the daily what? Rate. And we know property taxes are annual. 2,652 is what they shared with us, correct? How do you get from annual to daily? You divide by the number of days in the what? Yes, and they say use a 365-day method. You could pull up your calculators, and it's as simple as this. You take 2,652 and you divide it by 365, and you get that daily rate. Keep it in your calculator. Don't round, because we're going to need it. I'm just going to, use 4 numbers after the decimal. 2657. We'll just leave it there. We're going to need it for step number 2, but before we get to step number 2, we need to identify what the closing date is. It's going to help us answer this question, of course. Closing date is April 22nd. Non-leap year, and the day of the closing belongs to the buyer. They shared that with us as well. You have to know how many days are in each month. Why? Because step number 2 is multiply the daily rate by the days that were owned by the seller within the year, from January 1st all the way to the closing date, because that means the seller is responsible for that amount of property taxes based on how long they own the property. And you can use the knuckle method, of course, if it works out for you. And we can see how many days in January. Yep. February 28, non-leap year, they tell us within the question. March. Yep. And then April, it's not the full month. When does the seller stop owning? The day of the closing is April 22nd, but it belongs to a buyer. So when does the seller stop owning? The day before, right? On the 21st, being responsible for property taxes on the 21st. If you add those 4 figures together, do you get 111 days? When you add those, go ahead and add them. 31 plus 28 plus 31 plus 21. And tell me what you get. 111 days. We're going to need that for our calculation. We plug it in here and multiply it. So this is how much per day, $7 and change. And then times 111 days, should be in your calculator, multiply by 111, and then you get your result. Now you can round to the nearest cent. You get 806 and 50 cents. But that's not the complete answer. You have to know the credits and the debits. And you'll see it here. Debit to the seller, because they're responsible for that. They pay that. And the buyer gets credited this amount. Because whoever the owner is at the end of the year, November 1st, is responsible for the entire tax bill. So you want to make sure if you close on the property prior to that, the seller pay their share. And what answer? It could be A or B, but depending on the credits and the debits. Remember, it's debit seller, credit buyer. So it's letter C. We got to know the credits and the debits. As we just laid out, remember that 806.50 is something the seller is responsible for paying. So take away from the seller, debit seller, credit buyer. All right, let's close that out. Free up some bandwidth here. Number 12, a woman paid or bought 3 200-foot lots on a lake for $500 per front foot each. She then subdivided into 6 lakefront lots, which she then sold for $62,500 each. What is her percentage of profit on the sale? So we know it's the profit or loss formula. All right, let's pull up that profit or loss. Close this out real quick. Here it is, profit or loss. Here's the thing. We have to get the rate of return to find out how much profit or loss. They don't directly just give us the numbers we need. We can figure it out, but you got to pay attention. And this is how you figure it out. This is the best way, in my opinion. You might have done it a different way. It's okay. But she had 3 200-foot lots on a lake for $500 per front foot each. But then she took that and subdivided into 6. If you do this math, You'll find out her cost. You get her cost per lot, what she paid per lot. Do the math. Take 3, multiply by 200, multiply by 500, then divide by 6. And tell me what you get. You got 50,000? I'll do it with you. Look. 3 lots, $200 feet is the frontage, and then the cost, the value per frontage foot is $500, and that gives you 300,000. But then she subdivided into 6, so that gives you a cost per lot. Each one of those 6 lots is $50,000. That's her cost. But then she sold each of those 6 lots for how much? They tell us in the question. $62,500. Based on this information, did she make a profit on every single lot? Let's figure out her profit per lot. So let's do the math. You isolate rate of return, you get rid of everything else. In this case, the 50,000, you slide and divide. You take 62,500 divided by 50,000, and you get 1.25. Is that right? When you do that math, take 62,500 divided by 50,000. Did you get 1.25?
Yep.
Which is how much percent? You can multiply by 100 or move the decimal 2 spaces to the right to convert it to a percentage. It's 125%. We need that for calculating profit. Remember, that was just the rate of return. 125% rate of return. One more step to get the profit. Before you can start to make profit, you need to at least break what? Which is getting how much percent of your money back? Yeah, all of your money back is 100% of your money back. Anything left over is your actual profit, and that means the profit was 25%. Does that match? Correct answer is B as in Bravo. Any questions here? All right, let's move on. 13. This one, you just need to know how to calculate the area of a space, like width by depth. You can get the square footage of a specific location. Anyhow, a warehouse measures 720 by 500 feet and rents for $118,000 per month. What's the rent per square foot per month? Let's first identify the total square footage of this warehouse. You take 720 and multiply it by 500, and that gives you 360,000 square feet. Is that what you got? Well, how do you get the rent per square foot per month? You take the rent, which is 118,000, you divide by the square feet. Then you get the rent per square foot of what? Round to the nearest cent, it's going to be 33 cents per square foot per month. Correct answer is B as in Bravo. If you made the mistake, you reverse these numbers, you took 360,000 and divided by 118, they prepare for you making that mistake, and you would have got letter C. But I assure you, this is the correct way to structure. If you want to get the rent per square foot, you take the rent and divide it by the square feet. Then you get the rent per square foot. The name kind of gives it away. All right, we worked on 14. The correct answer was B as in Bravo. We worked on, no, we didn't do 15. Let's work on 15. A couple is purchasing an apartment building. Each of the 5 apartments rents for $815 per month. The closing is scheduled for September 16th, and the rents were collected on September 1st. What is the rent proration for this transaction, and to whom will the amount be credited? Day of closing belongs to the buyer. This is how we figure it out. We start with the monthly rent. Let's identify. It's $815 per unit, but how many units are there? 5 units. So what's the total rent collected from all tenants in the month? $4,075, right? Our first task always, when doing a proration calculation, is to get the daily what? So how do you get from monthly to daily? Well, you divide by the number of days in the what? In the month. And let's identify the closing date because that will tell us what month we're in. It's September 16th, right? And the day of the closing belongs to the buyer, but we are regardless in September. And how many days in September? There's 30 days in September. So take that amount, divide, and tell me what you get. We take 4,075, divide it by 30, and you get 135,833,333. Continues on into infinity. 135.83. We're going to need that for step number 2. And what do we do in step number 2? We multiply the daily rate, which we now have, by the days the buyer owns the property within the month, because what's the purpose of this? The 4,075 was already collected by the owner who's selling it to you. So you want to make sure that when I buy it within the month, I get part of that rent that you already have in your pocket. So how many days does the buyer get credit for? Well, from the closing date all the way to the end of the month. The day of the closing does belong to the buyer. You start on the 16th, 17th, 18th, 19th, 20th, all the way to the end of the month. We can tally. Don't be afraid to do so you don't make a mistake. 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29. There's 30 days in the month, and that is 15 if you add up those tallies. And that means when you multiply, we take what's in our calculator, multiply by 15, you get your correct answer. Yes, which is 2,037 and 50 cents. Does that match up with letter C as in Charlie? Any questions? We worked on 16. The correct answer was D. 17. How is a buyer's binder deposit going to show up on the closing disclosure in regard to the credits and the debits? Well, take a step back and think about, is anybody debited the deposit on the day of the closing? Because that's what the closing disclosure reveals to us. The money exchanged between the seller and the buyer on the day of the closing, not prior, on the day of the closing. The deposit, was that debited from anybody on the day of the closing? No. When was the deposit given by the buyer? 30, 45 days prior to the closing when their offer was accepted. It was just being held in an escrow account until the day of the closing when that money is going to get dispersed, right? So it's not going to show up as a debit because nobody's debited, but it will show up as a credit. Who gets credit for their deposit towards the purchase price? It's the buyer. And that's why it's B as in Bravo. They get credited that deposit towards the purchase price. How is the purchase price going to show up? Well, once again, take a step back. Is anybody debited the purchase price on the day of the closing? Who's responsible for paying the purchase price on the closing date? The buyer. So you debit the buyer, and simultaneously, who gets credit for it? The seller. Minus any debts that they have, right? What answer reflects that? Is that C? How are unpaid property taxes going to show up? Debit to seller, credit to buyer. We saw that a number of times already. And 20, we worked on this. The correct answer was D as in Delta, right? All right, let's move on to Unit 18. How'd you guys feel about the math after you went through it? Challenging yourself. It's the first time. You said taxes? Okay. Yeah, the formulas are what they are. You have to spend the time to work through these. Practice questions is the best way to prepare for your exam. So you need to get your hands on as many practice questions as possible. That's why I made the exam prep for you. It's the cheapest exam prep you can find on the market. There's nothing that exists that's $10 a month. Nothing. How long is it going to take you to pass your exam? Is it going to take you more than a month? Probably not. Okay. So spending $10 and having access to hundreds of math questions, practice questions in general, math videos. By the way, if you feel like you need to hear the math once again, versus being here in class, I recorded myself going through every single one of these math formulas with an example in every single one of those videos. So you can work through these problems and watch it as many times as you wish, pause it, rewind it, slow it down, playback speed, all that stuff. Utilize it. It's worth it. And you could just scan the front of your textbook, the QR code that will give you access. Let's move on. All right, here we go. So for Unit 18 questions, we worked on number 1. The correct answer was B as in Bravo. But let's move on to number 2. Each year in Florida, property taxes become delinquent on April 1st. Yes, you got it. Property taxes become due for the current year on November 1st. For your homestead exemption, if you're trying to file your property as your homestead, your primary residence, and get the benefits that come along with that, your filing window is between January 1st and March 1st. Number 3, if you disagree with the assessed value of your property, what's the first step? Yes. So the correct answer is A is an alpha. 4, the value adjustment board, you're not going to be tested on this, is C, consists of those individuals. Number 5, a widow, permanently disabled, non-veteran has been granted a homestead exemption on the $270,000 residence. How much is the total homestead exemption for a county? Well, if you could look at that chart, the one that I provided to you, it makes things a lot simpler. Looks like that. First of all, we start here with the assessed value. That's going to determine her initial exemption. Is her assessed value over $75,000? Yes. And in the question, they said for a county, right? County taxes. So we're going to look under county. Does she qualify for the initial $50,000 exemption? Yes. So she gets $50,000 right off the bat. Plus, she's a widow. How much do you get for being a widow? Exactly. So add those two figures together. What's your total homestead exemption for county? It's $55,000. The reference chart makes it easy. Obviously, you have to dedicate it to memory for your exam, but I try to put it all in one place for you to make it easy to study. 6, which statement is false concerning Florida's Greenbelt law? Well, it's D as in Delta. It's not the purpose of it. It's to charge farmers the lowest rate of taxes, really stimulate agricultural use of property, growing crops and raising animals for whatever purpose, cheese, meat, so forth. 7, if the lot frontage is 100 feet, street paving cost is $40 per running foot, the city is going to cover 25% of the expense. What is your special assessment? Let's go ahead and work through it here together. Let's go through some math. Your lot frontage is 100 feet. They identify that for us, and it's $40 per linear foot. That gives you $4,000 for that street paving for that 100 feet. However, the city said they're going to cover how much percent of the expense? 25, which means you cover the difference, which is 75%. And when you do the math, you get $3,000. But remember, there's two sides to the street, which means you only pay what? Half. So you divide by 2 to get half. And yes, when you do the math, you get $1,500. Does that match up? Yes. You'll notice they include that you encounter, right? Don't you encounter 3,000 and 4,000 in this math to confuse you, to throw you off? Got to remember, last step, divide by 2. You only pay half for street paving. And that's most likely the type of calculation you're going to make for special assessments. All right, number 8, a widow owns a home in Gainesville and Alachua County. The city tax is 9.3 mils, county is 9.7, and school board tax is 6 mils. Duval. Anyhow, the woman has a homesteaded principal residence and assessed at $178,000. How much taxes does she owe? This is where you got to pay attention. We can take out that handout for calculating property taxes and go through these motions together. Let's first identify, and I need you guys to have your calculators out. participate here. The assessed value for her property is 178,000, right? Are we clear on that? Does she qualify for any exemptions? Says she's a widow? Okay. What about homesteading her property? Is her assessed value over 75,000? Yeah. So don't you get an exemption for that? You get $50,000 off, 50K off. Well, let's make it a little bit smaller so we have space here. 178K. You subtract 50,000 right off the back because of her homestead. It's over 75,000. And she's also a widow, right? So you get 5K for that, correct? And what's left over is the taxable value. That's the amount you're actually going to be charged taxes on after your exemptions that you qualify for. And tell me what you get. 100 and what? 23? 123,000. Okay, that's taxable value. We're just focusing on these exemptions first, okay? So bear with me. It's going to be the same thing for county. The math doesn't change. City and county, hand in hand with one another. But then for school board, remember, exactly. For school board, your initial exemption for your homestead stops at 25,000. You don't get the maximum 50. So let's adjust. Take that 50,000, turn it into 25,000, and change the taxable value to what? 158 or something? 158. That's the taxable value. What do you mean? For school board? Right here. You see? Her assessed value is over 75,000, but for school board, she qualifies, she gets the base of 25,000. Plus she's a widow. She still does get the 5,000 for being a widow.
So for the homestead and school, it only goes up to 25.
Yeah, for school board, you get 25,000. You don't get the 50 like you do for city and county. Do you see? City, county, 50,000. Plus she's a widow. She does qualify for the additional 5,000. Anyhow, we have to now do the calculation for converting mills. Oops. How many mills are they charging you for city? Was it 9.3? 9.3 mills? But how do you convert it? You simply divide by mil, which is what? 1,000. And you get the true decimal form, which you're going to utilize for your math. 0.0093. Are you with me? You understand how I did that? When you're converting mills? All right, for county, it's 9.7 mils, which you divide by 1,000, you get 0.0097. And then for school board, it's 6 mils, correct? So we can change this 6 mils, which is going to be 0.006 when you divide by 1,000. All right, now that all of that is done, we can focus on the math. We simply multiply across, guys. You see? You take the taxable value, multiply by the rate, and tell me what you get. Everybody should be doing this. I'm relying on you guys. You get 123,000. Multiply by 0.0093. And that's what I got. 1,143.90. Did you get the same? All right, and then we move on, clear it out. 123,000 is our taxable value. Multiply by 0.0097, and we get 1,193.10. And then when you take your taxable value of 158,000 for school board and multiply by 0.006, you get 888. Is that right? No. Is that right?
Shouldn't it be 48?
It should be 48. That's the difference. So it wasn't 158, it was 48. Okay. Thank you for that. That was a test. Good job. 148,000 Now you multiply by 0.006 and it should be 888. Yeah. And when you add those figures together, add those three figures together, the sum of all taxes is how much? 3,225, is that right? And that would be letter B as in Bravo. Any questions? Did I lose anybody? It's a little bit tedious, I get it. Takes a little bit of time to solve that problem, but I mean, the math is not very complicated. You just have to remember the exemptions. That's the sticky part of it. Yeah, just got to remember all those exemptions. What's the maximum interest you can make off of paying somebody's taxes? Well, 18%. 10, what'd you guys get? Yes, the C is in Charlie. Anything over that $500,000, if you're a married couple filing a joint return, it's going to be capital gains tax that you're going to be responsible for. But I mean, $500,000 profit from the sale of your primary residence. Pretty cool. All right, number 11, the maximum amount of profit that may be excluded from taxation from the sale of a home for a qualifying couple filing separately is what? 250,000. If they're filing jointly, double it. 12, what'd you guys get?
D.
It's D as in Delta. All right, number 13. What'd you get? It's A as in Alpha. 14. Not deductible expense. Reserved for replacements. Yeah. All right, and 15 is D as in Delta. Yep. Any questions here? Any questions? All right, let me explain how today is going to go. We are going to finish the book today.
Sounds good.
So you're probably wondering, what does that mean for tomorrow? Tomorrow, I'm still going to give you credit for tomorrow. But you're going to use tomorrow for review and preparation for the class exam. Okay? So you're going to study independently. Hybrid. You know exactly what to study. You have all the highlights. You have a study group. Push each other. Make flashcards. Do what you got to do. I want to see 100% on the class exam. You know what you're tested on. Should be no reason why you shouldn't get 100%. No pressure, okay? But you should, I mean, come on. What's your passing grade need to be on your first attempt? 70% or higher. Please pass, okay? It's going to be a good day for both of us because I want you to pass. I don't need you to pay tuition again. I don't need you to sit through class again and pay more money. I just want you to get your license. That's the most important thing. So you have the tools. You'll have the tools by the end of this class. Obviously, you have to study. You have everything that we provided to you. We simplified as much as we could. You should have the tools for success, but you got to use the tools. Nobody's going to study for you. Nobody wants it as bad as you want it. Nobody's going to take your test for you. Prove everybody right or prove everybody wrong. Whatever your vendetta is, do it because you're better off having the license than not. And you'll see once you get out there and you'll be like, oh man, you're thinking about selling your house. You're going to start paying attention to those types of conversations. Man, if I had my license, I could have helped them out. I would be in the perfect position. Get your license. Be prepared for those conversations. Be ready for that opportunity. Man's greatest regret in life is that you didn't take advantage of an opportunity when it was presented to you. And I think those opportunities are divine. Okay? It's presented to you for a reason. It's a gift. You got to take advantage of those gifts. But let's take a break and we're going to get started with our session. Yes, question? On your exam? Of course. With a calculator. You're going to take it. Yes. So you're going to take the final exam through our system on our website. You log in, click on the final exam. When it's unlocked, you'll have access to it. Once you click that start button, it's going to be timed. I'm going to go through this again at the end of class. and you take it independently. Quiet space, no distractions. You can use a scrap sheet of paper to copy down notes. That's it. All right. It's not an open book test.
And Michael, sorry, how long is it? How
3 hours.
long? 3 hours? Okay.
Yeah, I'm going to repeat all of this at the end. You remember the 5-step guide that we went through on the first day of class?
Yeah.
I'm going to go through that again with you guys to
Okay.
make sure you have no doubt as to what steps need to be completed to get your license. Okay? But for now, let's take a break. I want you guys to be back at 10:10.
You can do that. I already have all the formulas written down and categorized the way I need them. Yeah, these are all. You can keep.
Oh, thank you. Okay.
All right. Unit 16. There we go. And I'm going to review some things we talked about on the first day of class in regard to appraisal. If you can recall some of this, just follow along. I can get some participation here. There we go. All right, on the first day of class, we talked about what appraisal is. It's the process of estimating real property value. It's an opinion given by a skilled estimator that results with the estimated value for a whatever property. In this unit, we're going to learn the methods used to figure out the value of property. This is extremely useful because when you're listing property for a seller, you need to know what to list it for. And when you're working with a buyer, same thing, you need to know what a fair offer for that property is. And that's why these methods are so crucial to us and our success as a real estate professional. You have to be able to determine value of real property. Otherwise, it's going to be very difficult to operate. Now there's tools that exist. There's something called Cloud CMA. Once you become a realtor, you'll have access to it. You punch in the address, some basic information, size of the house, and it spits out the high, medium, and low price for that home based on what other properties of similar size and quality have sold for within the surrounding area. You know what a CMA is. We talked about it on the first day of class, comparative market analysis. We just have tools, access to tools now that make that job easier. And of course, you can automate some of this as well. You know about automation and what exists with that and AI agents and so forth. So you can set it up where you have a Facebook advertisement, free home estimate. They can click on that, automates a form to populate. They fill out the form, it automates sending you, pulls their data and the information they share about the property into Cloud CMA, prepares the valuation, and then sends it right back out to them. All of this can be automated nowadays. This is with AI and everything that exists with AI and automation. A good tool for you guys to start utilizing, not that this unit has anything to do with it, but I'm big on technology and I'm big on artificial intelligence, is Zapier, Zapier.com. Zapier, Zapier. This is the entry level experience you're going to get with automation. You can start connecting tools to one another and make your business more efficient so you're not stretching yourself thin. And you might be thinking, okay, well, business is booming. I need help. I'm going to get a virtual assistant. You might not need a virtual assistant with all these tools that exist, AI and automation. Even when in the last presidential race, who is this guy that was talking about AI and automation taking over everybody's jobs? It was Yang, Andrew Yang, or Wang. It was the Yang gang, Wang gang, something like that. Anyhow, but it's real. It's what's going on right now. A lot of people are losing their jobs to automation. You can automate for social media. Did you know that? So you can have social media posts throughout the week automated based on a schedule you dictate and what you want it to automate. I have systems right now. I have a blog. And the way the blog works is it scrapes the internet, Google Trends. It will find the top trending topics in relation to real estate, mortgage, insurance. It will take those articles and that information. It will bring it into the system, use AI to rewrite the article, include information about Cameron Academy somewhere within the article, publish it on our website. Once it hits our website, automatically publishes to all social media accounts. Okay, it's intense. And it's a beautiful thing that exists right now. It's a tool that you can utilize. Just makes your life way easier. anyhow, I don't know why I thought to tell you that. Usually I don't start the unit by telling you about automation and all of these things, but I think maybe it's important for you to hear it, and somebody needed to hear that message. So Zapier allows you to automate between tools. For instance, you have Google Docs, you have Gmail, you have all these other tools that exist, social media accounts, Facebook. So you go on a Zapier, you log into your Facebook account on Zapier, you attach that tool, Facebook, to Zapier, and then it allows you to control Facebook through automation, and you can set tasks for it. And then you can connect Facebook to forms and advertisements and analytics and all of these things. It's just amazing what you can do nowadays. And if you want to be a top real estate agent and you want to get ahead of the curve, you want to actually be on the cutting edge of technology, this is how you do it. This is how you can compete with the top dogs, by really harnessing this type of technology. If you learn it now, you'll be unstoppable, hands down. You can use it for listings. You can use it for all kinds of wonderful things that you're doing in the business. Send out email blasts to people. They message you. It can respond on your behalf. You have cold call lists. You want to send out automated text messages. All of these things can be accomplished. So with that aside, back to appraisal. Remember, appraising is an art, not a science. And even though we're going to use mathematical calculations, methods to figure out the value of real property, it's not 100% accurate, because once again, it's an opinion given by a skilled estimator. And like the saying goes, who has an opinion? Everybody has an opinion. Everybody has their own 2 cents and wants to throw it in. So there's no two estimates of value alike. They could be pretty close to one another, but it's that estimator and what they think the property is worth. Same thing for you as a real estate professional, because can't you establish the value of real property? Can't you provide that as a service? Yes, you can. You just can't represent yourself as a state certified or a licensed appraiser. That was on the first day we talked about this. That's a completely separate license, an appraisal license. Do you remember that? Okay. So with that being said, I want to share some additional information with you and review just a little bit more from what we talked about on the first day. If we go to page 362 at the bottom under Appraisal Foundation, I want you to highlight these two. Qualifications Board. What's the purpose? They establish minimum criteria for state certified appraisers. And the Standards Board, you'll see right here, sets minimum standards for appraisals performed for federally related transactions. Do you remember on the first day when we talked about your estimate of value cannot be used for any federally related transaction? A real estate financial transaction, essentially real estate transactions where financing is involved. They won't accept your estimate of value for that type of transaction to get the loan or base the loan off of. They're going to use a licensed appraiser to provide that service, an official appraisal report, which you're not going to provide. You're just going to provide either a CMA or a BPO. Go to page 363. There's 2 types of state certified appraisers. The first one is residential, which estimate the value of what type of property? Residential. And then you have general, which estimate the value of any type. On line 8, you'll see that. Any questions? I just mentioned to you what a federally related transaction is, right? You'll see right here. It's a real estate related financial transaction. That simplifies it. And we know these types of transactions are governed by federal laws. Do you remember the federal laws we talked about? TILA, RESPA, ACOA. Okay, the rules that appraisers must follow when providing appraisal services is a USPAP. We saw that on the first day of class. And then we come across, I'm just reviewing with you guys. Let's go down. We already talked about CMAs and BPOs, right? Comparative market analysis, BPO, broker's price opinion. Remember, CMAs and BPOs, this is something we talked about on the first day, do not have to comply with the rules that appraisers must follow when providing an official appraisal report for a federally related transaction. If we go to the next page, now let's learn some new information. Cost, price, value. A lot of us use these terms interchangeably. What's the cost? What's the price? What's the value? How much did you pay? But each of these have their own meaning. We need to know the difference. So what is cost? Cost is the expense to create the good or service. You'll see that here. Do you see create right next to it? Price is what is paid for a good or service, or what it's sold for. And value is what it's worth. But I like to say it's the power of what could be exchanged for the good or service, what it could be exchanged for. The power of what it could be exchanged for. So how might you be asked to identify this terminology on a state exam type question? They might say something like this. A house was constructed for $500,000. What is that? Cost, price, or value? It was cost, the expense to create. So if they say it was constructed for a cost of $500,000, that's cost. It was appraised for $700,000. Value. Who determines value? An appraisal, right? An appraiser, excuse me. So that's a clear indication of what the value is. And it sold for $600,000. What is that? It's price. Good. Let's move on to types of value that you should be familiar with. Let's go through each one. The first one, we saw this multiple times. Assessed value. This is determined by a county property appraiser for tax purposes, right? Remember, property taxes are ad valorem. That means according to the assessed value, the higher the assessed value, the more taxes you pay. Insurance value is the value to replace or repair certain things based on unforeseen risk, natural disaster, catastrophe, like what happened with the fires. A lot of these homes in the Pacific Palisades in California, they took away their fire insurance coverage. Like right before these fires, can you imagine? And people are thinking, okay, it's kind of weird. And then the fire hit, and then it's like, oh my gosh, I need fire insurance. And now how are you going to recoup? The next type of value, we're going to be tested on this, investment value. I know it sounds kind of simple, but it's the value according to an investor. And each investor has their own financial goals that they want to accomplish. You as an investor might not have the same reason for buying that property as I do. Maybe I want to get the best deal for that property because the rental income that it produces is going to help me reach a certain quota. But for you, maybe you're thinking, I'm up against a 1031 exchange. I have to use all the profits from the sale of that last property I sold and roll it into the next property. I can't touch a cent. So I'm actually willing to pay maybe even a little bit more for the property so I could use all of that money. And how can I compete with that? But that's your own financial goal. That's what we see here in front of us. It says their own financial requirements and income tax situation. Liquidation value is what you can sell it for as a forced or rapid sale. If you had to sell it immediately right now because you had to, what's the most that you can get out of the property? That's what liquidation value is. Going concern value, we're going to come back to this in a later unit. But then we come across salvage value. This means if your property were to be completely destroyed, what's the value of scrap materials that could be salvaged? These raw materials have a value, and that's the value that we're referring to here. But the most important value that we're going to discuss in this unit has its own section. It's the next subject down, starts with the letter M. What type of value? Market value. Let's read through the details, the description of what market value actually is. And that's what this unit is all about. How do we figure out the market value for a property that we're listing for the seller? Or when we make an offer for a buyer, what's a fair offer based on market value? On line 16, it's the most probable price a property should bring in a competitive and open market. meaning it's not a closed market, not like for just a few group of individuals. It's not exclusive. It's open to all. This is how we determine market value of a property. It has to be open market. And then it says competitive. I think that's self-explanatory. Under all conditions requisite to a fair sale, meaning neither the buyer nor the seller is under any pressure to purchase or to sell. This could jeopardize what it should really be sold for. If somebody's desperate and the market is in a frenzy, interest rates go below 5%, and everybody waiting on the sidelines is jumping in and thinking, this is my time to become a homeowner, a buyer might be willing to overspend for a property just so they can lock it in. That's not what market value is. It's just what they're willing to pay. And then on the other side of the spectrum, if the seller's desperate, they have to sell. They might be willing to compromise what it's truly worth, the value of it. So it has to be a fair sale. And then it says both the buyer and the seller are acting knowledgeably, equally knowledgeable within the transaction. If one party is more knowledgeable than the other, that could once again jeopardize what that property is sold for. If the buyer doesn't know anything about that property and the seller really makes it sound great, maybe they can get them to overspend. Just giving you a hypothetical. And then assuming the price is not affected by any undue stimulus, any drastic change in our market like what happened in 2008, some unforeseen change that causes home prices to go down. So assuming all of these conditions are met, we can use these methods that we're going to learn within this unit, the 3 methods of estimating real property value, to figure out true property value of any property. And I'll show you what those methods are in a moment. We're not there yet, but let's continue on. In order for anything to have value, it has to have at least one of these 4 characteristics. Think of the acronym what? DUST. Okay, think of the acronym DUST. Let's go through each one on page 366. Does the good or service have a demand, a desire, a need to it? Is that going to dictate value if it has desire or need? Of course, yeah. Utility, do people feel like the good or service is useful? Does it fill somebody's need? That's going to dictate value. Scarcity is the availability of the good or service. Is it scarce? Is there not much of it available, or is it abundant? That's going to dictate value. And then we come across transferability. How easily can that good or service be transferred from one company or individual to another? An example, like a property that has a clear title versus a property that has a clouded title. One is easier to transfer because it has no issues with the transferability, and one is not. Let's go down to the bottom of this page. I want you to highlight, starting on line 23. Highlight that paragraph, something called the principle of substitution. The principle of substitution is going to be constant within all 3 methods of estimating property value that we're going to learn in our session for today. What does it mean? It means in order to figure out a value of any property, you look in the surrounding area for properties that are similar that have recently sold. And based on that information, you can dictate the value of your property. So the principle of substitution means if that property across the street that looked like mine recently sold for X amount of dollars, I should expect to get X amount of dollars for my property. We're substituting value. That's the substitution of value. Let's move on. Go to page 367, highlight the shaded box. We see highest and best use. Let me simplify what this section is all about because they go into detail for not much of a reason, if you ask me. Highest and best use is if you're working with an investor. An investor, they might want to know if they're going to buy a property, what's the highest and best use for that property? I think the name gives it away, but what does that actually mean? Essentially, the investor is asking you, what is the most profitable thing that I can put on this property? If I buy that property, what's the need for that area? Maybe they do some research and they find out a parking garage is the best use because there's lack of parking in this area. And if you construct a parking garage, you charge people to utilize it, you'll make a killing. Okay? But this comes with research. Real estate agents make big bucks off of this. Think about Chick-fil-A, think about Starbucks, think about Target and so forth. You think they just put these businesses wherever they want just because it's a feeling? No, it's based on research, demographic research. So they find out what's the medium income for this area. Is that type of person our ideal client? Would they be willing to spend money on this business if we place it here? And that's why investors, when they're looking for investment property, will look for property near Starbucks, near Chick-fil-A, and so forth, because they've already spent millions to do the research as to what the ideal locations are, and they believe that location is going to continue to grow. So if you buy in that area, it could be potentially a good investment. Does that make sense? Let's move on. Under increasing and decreasing returns on page 368, line 7 and 8, you're going to see some terminology. It's in bold. Highlight this. It's an overimprovement. Overimprovement exists when an owner invests more money into the property than what they can expect to recapture when they sell it, or recapture in value add. What do you think is the most common example for overimprovement for a home in Florida? Yes, say it, Francisco. A swimming pool. Because how much does it cost to construct a swimming pool? Yeah, like 60 nowadays. When I first started looking for a pool, the lowest quote I got was like 25,000. This was like in 2016, 17, something like that. And now it's double. Well, yeah, you have to have certain protections. You have to have screens and fences and all of these things. It's regulation, so nobody wanders into your pool. Anyhow, what is a pool? It's going to cost you 60 to build a standard pool, right? What is it going to bring you an added value to the property? The rule of thumb is about 50 to 60%. 50 to 60% of what you spent to construct it. So it's always going to cost more to add it than what you can expect to recapture. And then adding a pool, there's more liability and it's more responsibility. It's more of an income liability. Like you have to spend money to maintain it. You want it to look pretty every time you go outside, right? And that's a monthly charge and so forth, and chemicals and all these things. It could be reassessed, yes, as well. But here's the thing. When somebody's moving from Connecticut to Florida, they're thinking, if I'm moving to Florida, that house better have a flipping what? Pool in the back. Because why not live the dream? So pool homes are typically more in demand because of that. Does that make sense? Depends on the condition of the market. Florida is one of the most moved to states in the nation. And during the pandy, a lot of people moved here because of politics and so forth. But I'm not going to get into that. Let's move on. Assemblage and plottage. Let's talk about these terms. Assemblage is when you combine two or more lots into one single tract of land and try to sell it as one whole. That's what it's called. You're assembling. Assemblage. But something interesting, if you combine those lots and now it's worth more money when you combine them based on other properties of similar size, the added value is called plottage. I know it's an odd term to remember, but you got to remember that. Okay. Progression, regression. Progression is when you have an ugly house in the middle of a beautiful neighborhood. The surrounding properties will increase the value of yours. Have you ever seen this? Like these older, more established communities that are very desirable, but then you see that old Florida house, 1 story, barely breaking 1,000 square feet, but because it's surrounded by McMansions, it's worth $500,000, $600,000, and you're thinking, there's no way. But the market dictates that. And that house is probably going to remain because if property values are extremely high, no investor can come and tear it down and then build something that's worth more money, unless they absolutely want to overspend just to live in that community. Anyhow, regression is the opposite. It's when you have a McMansion in the middle of a not so good looking neighborhood. Surrounding properties will bring down the value of yours. But this is what I wanted to get to in this unit. This is the whole purpose of this unit, in my opinion, is these three methods. They call them approaches to estimating real property value. The sales comparison approach, it's called the comparable sales method. The cost depreciation approach, called the cost approach or the cost method. And the income capitalization approach, or income approach or income method. Let's go through each one. Starting with the sales comparison approach. And I made handouts for you to simplify how this works. So take out your handout that says sales comparison approach across the top. Looks like this. This is essentially a CMA, but a little bit more detailed. You remember the CMA? You're looking for similar properties that have recently sold within the surrounding area. You're looking for at least 3 recent sales. And how recent? They say within the past, no more than 6 months. But nowadays, with the market, the way it's volatile, I would say get as close as you can get to the current date as possible for recent sales. That means your estimate of value is going to be that much more accurate. And they say within a mile radius of the subject property. But let's face it, if the property is located within a subdivision, you should stay within the same community and find recent sales within the same community. Because you know as well as I, even though a recent sale is within a mile radius, it might be across the street in a community that looks completely different from the one that you're in and want to try to figure out the value of. Better or worse, it could be different. So you want to stay within the same community. That's the best way to figure out the value of a subject property. And this is our subject property. I made it up. It's just an example. It's not always going to be these features, but we're going to use these features to see how it works. Do you see subject property? Let's go through these features together. 3-bedroom, 2-bath, has a pool, 1,800 square feet. But our ultimate goal from this is to figure out the estimated what? Value. That's the only thing we're missing. So how do we do it? We look or we turn to recent sales of similar properties within the surrounding area. We call them comparable sales, or we call them comps in our business for short, COMP. You'll notice after the features are presented in green, do you see this? There's a value assigned to each feature. You don't have to remember these values. These are made up. It's just a what? An example. But in real life, you're probably trying to figure out, how do I figure out the value of a bedroom? How do I determine that in real life? It's based on comparing properties that have recently sold, once again, within the surrounding area. If there's 2 properties that are almost identical, one is a 4-bedroom, one's a 3-bedroom, and the 4-bedroom sold for a little bit more, you can probably conclude that the reason why it sold for more is because it has 1 extra bedroom. That will give you the value of that bedroom. I'm not going to go through it right now because on your exam, they're going to give you not only the features, but the value for each feature. The point of this is for you to know how to utilize this information. Let me show you how to utilize this example to figure out the value of the subject property. So I said each bedroom, $48,000 in value. I made it up. Each bathroom, full bathroom, $26,000, and a half bathroom, I cut it in half, $13,000. A pool, I put a value of $25,000 in added value to the property. And for every square foot, they have to share this with you, $175 per square foot in value. Now that we have this information, let's turn to our comparables. And the first step in this process to understand how it works is something called, go to page 370, the adjustment process. The adjustment process. You'll see in that first paragraph, they kind of describe it to you. But then if you look in this box, this is what I want to turn to, CBS and CIA. Let me show you something if I can get your attention real quick. It's going to make sense if you follow up here. Look at the comparables we found. I made them up. We know the features and we know what they recently sold for. Do you see the sale prices here? But the only reason they sold for these amounts is based on the features it has, which are not the same as the subject. So what we need to do first is adjust the features for each one of these comparables to make the features match the subject property. And that's what the adjustment process is. How does it work? Remember CBS and CIA. CBS, like the television network, CIA, like the Alphabet Boys. If the comparable property is better than the subject property, you must what? So if the comparable you found has a feature that's better, you got to bring it down to make it match the subject property. You'll see why this is relevant. And if the comparable that you found has inferior features to the subject, you must add to make it match. Let's see how it works with this example. Let's start right here. 3-bedroom, 2-bath. Do we have to change anything? No, we don't have to change anything here, guys. It's the same. Has a pool. Is that the same? Yes. But what about the square footage? Is that the same? Is it better or inferior? I'm asking you. It's inferior. So CIA, if the comparable is inferior, you must what? You must add. How much square feet are we adding to make it match the subject property? 200 square feet. Exactly. And we know each square foot, 175, right? You understand how you're doing the math? Let's do the math. We just know right here that we're going to add 200 square feet and it's $175 per square foot. Let's do the math down here. It recently sold for $303,000, but with 200 square feet less. If we added 200 square feet to make it match the subject property, then it should have sold for more. Let's find out how much more it should have sold for. Go ahead and do the math. Take 200 and multiply it by 175 and tell me what you get. Oh, wait. 35? Everybody? 200 square feet times 175 per square foot, you got 35,000. And that's for the difference in square feet. That's the only thing we had to adjust. Everything else matches the subject property, right? So let's adjust. If it had 200 square feet more, it should have sold for $35,000 more. And what's the adjusted sale price? $338,000? Is that right? What does that mean? It means this property, if it matched our subject property completely, should have sold for $338,000. You understand why this is relevant, why we're doing this? And we're going to do that for each one of these comparables. Yes, question. 33, what do you mean? I took the sale price of $303,000 and I added. You see, we're doing the math in this section. All right, let's move on to comparable number 2. 3-bedroom, is that the same? Do we have to change anything? No. But what about the bathrooms? Is that different? Yes. Is it better or inferior? It's better. So we need to subtract 1/2 bath, right? What about the next feature? No pool. Does our subject have a pool? Yes. So we need to add, because it's inferior, right? We need to add the value of a pool. And what about the square footage? You tell me. Is it the same? No, it's better. So CBS, if the comparable is better, you must subtract. How much square feet are we subtracting to make it match? We're subtracting 300 square feet. And we're going to do our math down here. It recently sold for $395,000 with its current features, but we need to adjust to make it match. So subtract 1/2 bathroom. And we have the reference, yes, $13,000 for the half bath. What about the next? We're adding a pool. So what is that? $25,000 for the pool. And we're subtracting 300 square feet in value. 300 times 175 is what? 52,500 for the difference in square feet. You understand where we're going with this? What's our adjusted sale price? You tell me. Take 395,000, subtract, add, subtract, and tell me what you get. What is it? $354, $500. Okay. Everybody concur with this? That's our adjusted sale price. Let's move on. Comparable number 3. Maybe this is the only other comparable we can find. You're looking for at least 3, and this is the only one we can find. And we can use it. We just have to adjust. 4-bedroom. Is that the same? No, we need to subtract 1 bedroom. We also need to subtract 1 bathroom, correct? Has a pool, no change there. But what about the square footage? Is that the same? No. How much square feet must we subtract to make it match? 850 square feet. Now let's do the math. We're going to subtract 1 bedroom, which is 48,000, right? That's for the difference in beds. We're going to subtract 1 bathroom, 1 full bathroom, which is 26,000. Oops. It's for the difference in bath. Oops. And we're going to subtract 850 square feet in value, which is what? 850 times 175. It's going to be like 100 and something thousand.
48,750.
148,750. That's for the difference in square feet. So you subtract, subtract, subtract. And what's our adjusted sale price for comparable number 3? 300 and what? 16,250. All right. What do we do with these 3 amounts? We calculate the average of these 3 amounts. How do we calculate the average of the 3? Well, exactly. This is what we're going to do here on the left. If you see what I'm doing, we take those 3 adjusted sale prices, we add those together. The sum of those 3 is going to give us 1,008,250. Is that right?
750.
750. If you remember how to calculate the average of 3 numbers from school, you add the 3 figures together and then you divide by the number of figures. Since you added 3, you divide by 3, and that will give you the average for all. So divide by 3 and tell me what your adjusted sale or your estimated value for your subject property is. 336, 250. Everybody have the same result? Yes? When you're working with a seller or a buyer, there you go. You figured out the value of that subject property based on those three comparables, what they recently sold for, and using the sales comparison approach, adjusting the features for each one of those. I think the value of your property is about $340,000. It's okay to give a round number. That's fine. It's your opinion.
Rough number.
And here's the thing. Maybe if I'm listing this property for a prospective seller, I'll say, hey, listen, I got about $336,000 for this property, but let's list it at $349,000. Because you know how the market is. Buyers always want to feel like they got a great what? So they always offer just a little bit what? Less. And we know that our bottom number is about 336. We can rely on that for appraisal purposes based on this method that we used. So it's a good way to attack. Any questions here? Before we take a break, there's an add-on to this that I want to share with you. And it's to make your estimate a little bit more accurate. It's called reconciliation. Reconciliation of value. If I can find it. There it is. Francisco, you're in accounting. You know what reconciliation is. Reconcile bank accounts, just check for accuracy, make sure there's no errors. It's the same thing for estimate of value. When you're reconciling the value, what are you doing? You're providing a more accurate estimate by identifying which comparables have the greatest weight on the value for the subject property. Weights are determined by the estimator. I'll show you what that means. Based on how similar the comparable property is to your subject property. Note, and this is something you need to know, the sum of all three weights assigned must equal how much percent? So what do? We start off with the comparable adjusted sale price, which we already got. For a comparable number one, what was the adjusted sale price? 300 and what? 38,000. For comparable number two, it was 354,500.
Yep.
And then for comparable number three, it was 316,250. We'll need those to understand how this method works. Now, let me ask you a question. Out of those three comparables, the recent sales of similar properties that we found within the surrounding area, out of these three, which one out of these three was the most similar to the subject property? Which one out of these three did we have to change the least? 1, 2, or 3? It was number one, obviously. So shouldn't we rely on comparable number one to figure more so than the rest to figure out the value of the subject property? Because it's the most similar. If that one sold for X amount of dollars, well, it's most like the one that we're trying to sell. So it should have the greatest weight on the value for the subject property, and that's where these weights come from, but they're represented as percentages. So out of 100%, we're going to assign comparable number one the highest percentage. I'm going to make it up. Why not? 60%. Out of these remaining two, which one was more similar, 2 or 3? It was number 2, right? Let's assign it the second highest percentage, which let's say is 30. And the only other percentage we can assign to comparable number 3, because all 3 must equal 100, is 10%. So 60, 30, 10, obviously that's 100%, and those 3 weights must equal 100. What do we do with these amounts? Well, ABC, multiply across. Tell me what you get. What's 60% of 338,000? Do the math.
800.
202? 202,800. Make sure, don't just take your neighbor's word for it. Everybody should be calculating. We might miss a 0 or miss a decimal or whatever the case may be.
Big finger.
Yeah. What'd you get? What's 30% of 354,500?
106.
106,350. And then for comparable number 3. 10% is easy. It's 31,000. Exactly. 31,625, right? Now that you have the reconciled amounts based on how similar it was to the subject property, you add those 3 together, representing 100% of the reconciled value of the property. And what do you get? Add those 3 figures together. You get 300 and what? 347 and 75, like that. Okay, so through reconciliation, which is to provide more accuracy in your estimate, you find out that the property is worth a little bit more. Is it worth your time to do this? Probably not. Okay, the first estimate was pretty darn accurate. We're only off by a few $1,000s from the first estimate to the reconciled estimate of value. So are you going to use this in real life? Only if you're working with the seller and they say, hey, listen, I want to know exactly how much my property is worth. So that way there's no doubt in our mind, because I'm not going to sell my property for a dime less than what it's worth. We got to make sure that we know what it's going to appraise for. So you might use it in that circumstance, but when does the seller give you that type of instruction? It doesn't happen. Anyhow. And you should be happy if you get this as one of your math questions, by the way. This will be a separate math question in itself. Reconcile the value. Why? Why should you be happy? Because on your exam, they're going to give you the adjusted sale price for each, and they're going to give you the percentage for each, the weight for each. All you have to do is multiply and add. Exactly. Multiply and add, and you got your answer. Any questions here? All right, let's take a break. I want you guys to be back at a little bit more than a 10-minute. Be back at 11:10. 11:10. Stretch out, grab a snack, do what you got to do. See you guys in just a moment. Okay, it's time. It's time. Let's continue on to page 373. Page 373. And at the bottom of page 373, we see the cost depreciation approach, generally referred to as the cost approach. But the word depreciation reveals something to us. The reason why this method is different from the one we just learned about is because we're going to use depreciation as a factor to figure out the value of the property. If the property has existed for a certain time period, over time, it loses value because of wear and tear, poor design, the structure, surroundings, and so forth. And that loss in value is called depreciation. And we're going to see how that is going to be used in our adjustment of value. We go to page 374. Of course, you'll see between lines 9 and 10, the formula, but I made a handout for you guys that breaks down this formula. The first step in this calculation is to establish something called the reproduction cost. And that's the cost to reproduce the structure as if it's brand new, using the same exact materials. We're going to make up our own example of a property and see how this method works. But for a class exam question, you have to know the difference between reproduction cost and what we're tested on, which is replacement cost. It's once again the cost to reproduce a structure, but using modern, available, and updated materials, not the same exact materials that it was originally constructed with. And replacement costs, as we can see here on page 374. So reproduction cost is the cost to reproduce a structure as if it's brand new using the same exact materials. Replacement cost, the difference is you're using modern, available, and updated materials. And we want to be as accurate as possible. So we'll stick with reproduction cost. In figure 16.2, a portion of this is what you might be tested on for your class exam. One of your last 10 questions, which is math. Okay. The whole purpose, well, not the whole purpose, but the reason why we use this method is because we're factoring in depreciation into our value. And once again, what is depreciation? It's the loss in what? Yes, continues on to the next page, caused by wear and tear, poor design, the structure, surroundings, the proximity of the property. But our calculation is going to require us to utilize something called accrued depreciation. You need to know what accrued depreciation is. Accrued depreciation is a total depreciation that has accumulated over the years from the time it was constructed to the day it's sold, right? To try to figure out what the value of it is at the time of sale. I mean, this is most likely what it's utilized for, excuse me. Before we get into it, depreciation can be curable or incurable, depending on how expensive. Curable means you can fix the problem and get your money back in added value. Incurable means it's too expensive. You try to spend the money to fix it, add something, whatever the case may be. You're going to spend that money without getting reimbursed in added value. I'll show you why knowing this is important. And that's going to lead us down to line 18. Line 18. Depreciation in a structure can be attributed to three major causes. Physical deterioration, which is simply put, wear and tear. You see that? Wear and tear. An example of this, the roof, the shingles, they're falling apart because of exposures to the sun. They're brittle because of exposure to the elements over time. The paint on the outside is chipping, it's faded. But let me ask you a question. If we're talking about paint on the outside of the property, is that curable or incurable?
Terrible.
It's curable, not just because we can fix it, because you can fix most things in the property. You can rebuild the house if you want to, but can you get your money back in added value when you repaint the house? I would say so. Selling it as a brand new looking house versus an old beat up rundown looking house because the paint is faded and chipping and so forth. It makes sense. Incurable, an example. What about termites? Have completely destroyed the framing throughout the entire house and ate out the subflooring and so forth. If you spend the money to replace all the framing in the house, you're not going to get your money back in added value. That's incurable for a reason. For that reason, it's incurable. And the buyer who's purchasing that property, they're thinking, okay, well, congratulations on replacing all the framing. I'm not going to pay you more for the property. We expect the house to have good framing. It's unfortunate that the termites ate it all out, but you're going to have to spend that money. You're not going to get that money back. Next is functional obsolescence. This is poor design in a structure, like a 5-bedroom house with 1 bathroom. Okay. I've seen this recently. Usually it's a really old home built in the 1920s or whatever the case may be, but they still do exist. And it's unfortunate. But let me ask you, if the property is 5 bedrooms, 1 bathroom, is that curable or incurable? I would say it's curable, because every additional bathroom you add, you're going to get your money back versus selling it as a 5-1. It's much better if you sell it as a 5-2, right? You'll get your money back. Absolutely. I'll give you another example, and you tell me if it's curable or incurable. The house has no insulation. No insulation in the walls. Wood frame house, no insulation. So the house is not going to heat properly or cool properly because the insulation keeps that in. The air conditioning. So is that curable or incurable? I would say it's incurable, right? Because you'd have to tear down, tear out all the drywall, put the insulation, then put up new drywall. Then you'll have to mud it, sand it, texture it, repaint it. You think you're going to get your money back in added value? Probably not. But maybe it's a good selling point. Hey, listen, all brand new foam insulation. I don't know. And then we come across external obsolescence. This has to do with the outside, the proximity. If your house is constructed next to a train track, an airport, can you pick up the house and move it? And that's why it's always considered to be what? Incurable. By the way, we already learned this yesterday, but I'm going to repeat this again. We learned this in Unit 18. Line 33. What does it say? Land is not what? You're not allowed to use land in a depreciation calculation. Land is excluded. We know why, right? Depreciation is calculated on the structure, not the land. Remember this because we're going to see how it works. And we're going to learn about something called the AIDS life method to calculate accrued depreciation. And you're going to be tested on accrued depreciation. Class exam question. Okay. Now let's jump into it. Take out the handout that says cost appreciation approach across the top. Let's go through this together. These are the steps that you would follow. 4 basic steps. Don't be intimidated. I'll show you how simple it could be. Color-coded, coordinated, for your convenience. Let's jump through this together. The first step when calculating the value of a property using this method, this approach, factoring depreciation, you first start with the reproduction cost of the structure. Reproduce the structure as if it's brand new. Let's make up an example so you can see how it works. Let's say we're talking about a warehouse and we're trying to figure out the value of this warehouse using this method, the cost depreciation approach. Now, this method could be used for estimating the value of any type of property, but mainly it's used for commercial or industrial. And you can write that down at the top, mainly used for commercial, industrial. And our example is an industrial property. It's a warehouse. Most of the time on your exam, they're going to tell you the reproduction cost of that warehouse. What would it take to reproduce that structure, the warehouse, as if it's brand new? But just in case they don't give you this information up front, how would you figure it out with the right information? This is the type of information they're going to provide to you. They say the warehouse is 20,000 square feet. 20,000 square foot warehouse. And you get bids from local contractors as to what it would take to reproduce the structure as if it's brand new using the same exact materials. And they give you a price per square foot. I'm going to make it up because just an example. Let's say local contractors, the estimated or average price per square foot, $200. So 20,000 square feet warehouse. It would take $200 per square foot to reproduce it, rebuild it as if it's brand new using the same exact materials. So what would the reproduction cost be? It'd be $4 million. Are you with me? $4 million bucks. And we're going to need that for step number 2 and 3. Let's focus on step 2. Step number 2. Calculate the accrued depreciation. Now, this is where it gets a little bit weird. Okay. This is the weirdest thing you've probably seen thus far because it's so opinionated. And that's what an estimate of value is. It's your opinion, but you'll see how true that is with what we're going to discuss. Write this down. Age life method. This is the age life method to calculate accrued depreciation. How do you figure out the total depreciation that has accumulated over the years on this structure? That's what this is specifically utilized for. So let's go through it. You start with something called the effective age. And in the textbook, they don't describe well what this actually is. So I put it in parentheses. This is how old it looks.
Not how old it is.
So it's not how old it actually is. It's how old it looks. And you're probably thinking, well, how do you figure that out? Well, if you're the one that's estimating the value of the property, it's you standing in front of this warehouse and thinking, I think it looks about X amount of years old. And that's what you would use for the calculation. So you see how opinionated it could be? It's based on that person's opinion, the estimator. They're going to try to trick you with this on your exam. How? They say, based on public records, it's 40 years old, but it only looks like it's 20 years old because of exceptional upkeep and maintenance. What's the effective age? It's 20. How old it looks, not how old it actually is. That's where they get you. What if they only give you the actual age? Then you can use it. But most likely, they're going to tell you how old it looks, and let's make it up. Let's say 20. It's just an example. It looks like it's 20 years old. All right. And we take that, we divide it by total economic life. In other words, look in parentheses, I broke it down for you. How long you think it will what? Last. From the time it was originally constructed to the day it falls apart. How long do you think the structure is going to last? Maybe you're thinking, man, warehouses, they last decades, centuries sometimes. And I think it's good quality construction, solid foundation. I don't see any cracks or anything. no major disasters in the area. Maybe you think it's going to last 200 years. And that's what you would use for your calculation to figure out depreciation on this structure. Let's use that. Let's say 200. Take out your calculator. You probably already know what it is, but you take 20 and divide it by 200 and you get 0.1, right? Let me ask you a question. We got 0.1 as our depreciation rate. That's what we got. But what percent is that? If you were to convert 0.1 to a percentage, it's 10%. So basically what you're saying is this property has depreciated by 10% based on its existence, wear and tear, how old it looks versus how long you think it's going to last. Your opinion, you think it's depreciated by 10% over the years. And how would we calculate what 10% of 4 million is? We'll multiply it. Exactly. You take 0.1, multiply it by 4 million. And yeah, you're going to get 400,000. Essentially, what we just calculated is the total depreciation that has accumulated over the years as a dollar figure. We think it's lost $400,000 in value because of its existence. And the next step is to subtract it. Our reproduction costs, 4 million minus 400,000. What do we get as the reproduction or the depreciated structure value? It's going to be 3,600,000. We're using simple numbers, right? And we'll need that for step number 4. All right, step number 4, what do we do? Remember, we calculated on the structure. We were focusing on the structure because that's how depreciation is calculated, on the structure, not the land. But does the land have value that it's sitting on? Of course. And we have to add that to get the total value of the property. Depreciated structure, the warehouse, and the land that it's sitting on. In your question, they'll tell you what the land is worth. It's not something you have to remember or calculate. They're going to share this with you. Worst case scenario, they say it's sitting on 2 acres and each acre is valued at whatever amount of dollars. And you can easily figure it out from that point on. But let's make it up. Let's say the land that it's sitting on is $200,000. That's what they tell you in the question. So the total property value is 3.8 million, right? Any questions here? Yes, question. Yes, they have to provide it to you. You can't guess that. Because you have no structure in front of you, especially when you're taking your exam. I mean, they have to give you how old it looks and how long it's going to last. In order to do this calculation, you just have to know how to organize it and utilize that information. The math is not hard. It's not hard. It's just the weirdest part to this is the accrued depreciation. Remembering that you take how old it looks divided by how long it's going to last, and you multiply it by the reproduction cost. Yes, question.
Divide the how it looks by the how long it lasts. What is that exactly?
You get a depreciation rate.
Year.
No, total. Total depreciation rate. I'll make up a random example. Let's say you think the property looks like it's 10 years old. So you take 10 and divide it by how long you think it's going to last. Let's divide it by 150. I think it's the last 150 years. I'm just making up random example. This is what you get. And then, so your property basically has depreciated by 7%. That's 7%. That's the depreciation rate. Okay. Let's move on to what I like to call the income capitalization approach. They call it the income method. And we're using income that the property is producing to figure out the value. And this is very useful. It's one of my favorite because I'm on the investment side of the business. And as an investor, I have goals I want to accomplish. I have a return on my investment that it's a target for me to obtain when I purchase property. So based on this target, I can figure out how much I should pay for this property in order to hit that target. You can do your math in that way, or you can just use this to figure out, based on what it's producing as income, how much you should pay for it based on what other properties are selling for that are producing similar income within the market area. Let's use an example in the book, but this is also called the stack method, or the stack formula, excuse me. Write that down. Write down stack formula. And separately, I want you to add this as a note. Always calculate annually. Let me stretch this out. Always calculate annually. This calculation is based on an annual approach. Okay, not monthly. If you calculate monthly, they're going to prepare for you making a mistake, and you'll find an incorrect answer that matches with what you think it is. All right, so let's go to page 378. Go to page 378. Line 25. Page 378, line 25. Let me read this out to you. Let's use this framework of this practice question, this example, to understand what this method is all about. Suppose your client is considering construction of a 10-unit apartment building. You're estimating the value of vacant property zoned for apartments. Your survey of other apartment projects of similar size and quality in the market area reveals that each of the proposed new apartments could be competitive if rented at $665 per month. The survey also discloses that an annual vacancy and collection loss rate of 10% is typical for the area. Let's use that information to figure out what that property is valued at, what we think it's worth. And we're going to use something called the stack formula. You see it stacked. And we start with something called the PGI. And yes, they will use PGI in the question. And you have to understand what PGI stands for. In this case, I broke it down for you. It's potential gross income. In other words, if I can get your attention, in a perfect world, what's the most money we can generate off of this 10-unit apartment building? That's essentially what PGI is. What's the most money we can make? And how many units are there? There's 10 units. Could be competitive at rented at how much per month? Where are those located, right? And that gives you how much? $6,650. But this is per month, isn't it? What do we know? Do we calculate monthly? No, excuse me. What do we write down? We wrote down always calculate annually, because investors want to know annual, not monthly. So take that, multiply by 12, and what do we get? You tell me. We get 79,800. Is that right? Well, we just calculated almost $80,000 as a potential gross income. It sounds nice for a 10-unit apartment building, but we're not done, because do we live in a perfect world? No. So what do we have to subtract? You see the symbol here, the math symbol? Vacancy and collection loss. Vacancy means you have empty units not producing you income. Collection loss means you got tenants, but they're not what? They're not paying. And that happens as well. In the example, they said we're going to lose how much percent of our income annually because of it. Yeah, 10% is typical for the area is what they said. Let's use that. It's an example.
They always provide the vacancy collection.
They have to. So you take 79,800 multiply by 10%. And that's going to give us the amount we need for our calculation, $7,980, right? Is that what you got? This is what we're going to subtract. You see, we're going to subtract this amount because this is what we're losing annually because of empty units and units that are not paying. Next, we're going to add other income. But for this example, do they mention any kind of other income you're producing in this 10-unit apartment building? They don't. So we're going to simply add how much? $0. If I were to ask you, what could be some additional income that you would produce in an apartment building? What else could you charge for and generate additional income? Probably not maintenance.
Parking fees.
Yeah. What about reserved parking, reserved garages? What about concierge garbage pickup? Have you ever seen laundromats? What about vending machines? These are all examples of additional income that you can make, but there is none for this example. So we're going to simply add $0. And when you do the math, it's going to equal your EGI. EGI stands for effective gross income. What do we get? Do the math. 79,800 subtract 7,980 and tell me what you get.
1,800.
71,820. Did you get this same result? But what do we just calculate? We calculated, if you look up here, an effective what type of income? Gross. Do investors want to know gross income? No. Investors want to know what type of income. Look, net. But how do you get from gross to net? You have to subtract all relevant expenses. They have to give you the expenses in the example. And if you look in your textbook, it's provided to us on page 379. Look on page 379. What type of expenses can you encounter on an annual basis? Taxes, insurance, management. These are fixed and variable expenses that you account for. Repairs and maintenance and reserve for replacements just in case something goes wrong. And what's your total expenses amount to for the year? I just highlighted it. Total expenses, $36,990. By the way, next to this, I want you to write down, do not include mortgage loan payments. Yes, it's a calculation you can do independently just to know. But remember, mortgage loan payments are based on an individual's qualifications. So you don't use this in the calculation. If the investor wants to, they can calculate that for their personal knowledge. Mortgage loan payments. Do not include mortgage loan payments when you're factoring in expenses. These are fixed and variable expenses that you account for. But mortgage loan payments does not exist here, even though most people will get a loan to purchase the apartment building. Yeah. What do the expenses amount to that we're going to use for our example? How much? 36,990. And when you subtract that, it's more than half of our effective gross income, by the way. Gone because of expenses. What are you left with? $34,830. Did you get that? What did we just calculated? We calculated our NOI, net operating income, the clean money we're actually putting in our pocket at the end of the year. And that's what investors want to know about. So you answered one question for the investor. You're going to make about $35,000 clean money in the year. But we're not done. Now we're going to use that income that it's producing to figure out how much we should pay for this property. The only way to figure this out is to know what other apartment buildings sold for based on their income. This is going to give us something called a cap rate. Have you ever heard of cap rate in our business? It stands for capitalization rate. I'm going to break that down and help you understand what that really means and why it's so important in our business, especially on the investment side of our business. So how do you figure it out? Well, you take the NOI of similar properties that have recently sold in the surrounding area. What they were making is clean money, like we just calculated, and you divide it by what they recently sold for. That gives you a cap rate. We need it
for our calculation down here. And what we see for our calculation is something called the IRV formula. You see I equals R times V, IRV. It's just used to help you remember. Doesn't this look familiar to us? Isn't this an ABC formula? It doesn't matter if it's on the other side of the equation. It's still an ABC formula, A times B equals C. What do we just calculate as our net operating income? Exactly. We got 34,830. So we established we know what the NOI is, but our ultimate goal is to figure out the what for this property, the value. So we need to get this cap rate. I showed you how it's calculated, but guess what? They did the work for us in our textbook. Here it is. You see on that same page, they found 5 other apartment buildings of similar size and quality, A, B, C, D, and E. And look, they took what they were making clean money in the year and divided it by what they recently sold for. That gave us a cap rate for each one. But you have to calculate the what for all 5. You have to calculate the average for all 5. So what do? You add them together, and then you divide by the amount of figures you added together. So you added 5, you divide by 5, and you get 0.1, which is the same thing as how much percent. You still might not know what a cap rate actually is. I'm going to explain this in a moment. Just understand how you get it. We're going to apply it, and then at the end, it's going to make sense. I'll explain what it is and why it's so important. For now, 10% is our cap rate. Let's go back to our handout here, and let's fill it in. 10%. It's a backwards ABC formula. What mathematical symbol separates the equation from the left to the right side? What symbol does that? It's the equal symbol, right? And we're trying to calculate the value. This is what we're isolating. So what do we have to get rid of? We have to get rid of the 10%. How do you get rid of it? You slide and divide. It works every single time. So you take 34,830 and divide it by 10%, and you'll find out the value of that subject property. The value equals what? Yep. The value, when you do the math, essentially you add a 0, and you get $348,300 is what we should pay for that 10-unit apartment building. I mean, that's not really expensive if you think about it. I mean, people spend $350,000 on houses all the time. Imagine getting a 10-unit apartment building. But is this worth it to the investor? We answered a lot of questions for the investor. I'm going to ask you what you think about it. Look at what we just shared with the investor, which is relevant. We showed them that they're going to make about $35,000 clean money in the year, right? And based on that income and what other properties are selling for in the surrounding area, you can expect to pay about $350,000 for that 10-unit apartment building. But you still might be confused as to what that cap rate actually is. Now I get to share it with you and show you why it's so important. A cap rate is an annual return on your investment rate. That's what a cap rate is. So it's an annual return on your investment rate. Have you heard of ROI before? Okay. As an investor, before you can start to make profit, you need to at least break what? What is breaking even as a percentage? And we represent that as what? 100% of your money back. That's breaking even, right? But you are capitalizing on this investment at a rate of how much percent per year? You're getting a 10% return on your investment every single year. That's what the cap rate actually means. You see why this is so important? So you're getting 10, you just divide it by 10%. That's your cap rate. And that means you're going to break even in how many years? You're going to break even in 10 years. You think an investor wants to know that? If you're in the investment world, you already know. You know, if the cap rate for a property, which is what they advertise, they say, hey, cap rate for this property is 10%. You're thinking, oh, I could break even in 10 years. Does it sound attractive to you as an investor? Are you willing to wait 10 years to break even? Yes. Okay. In this market, investors are salivating over that opportunity. Right now, you'd be lucky to get 5% as a cap rate for a lot of these types of properties. 10% is great. And it's not the end of the story. Yeah, it's anticipated I'll get all my money back in 10 years, but what if the income I'm producing, that $35,000, when a tenant moves out, I fix up the unit, which means I can charge what? More for rent, which now means I'm generating more income, which means I'm breaking even sooner. And I'm increasing the what in the property? It's a game. It's all a game. And this is how you play the game. You need to know this when working with investors. And they're going to ask you to answer these questions.
Reduce expenses, all the lights that are old in it, replace them.
Absolutely. Go to LED, solar, whatever you want to do, you know? There's so many different ways. All right, let's move on. Here's the thing. Unit 17 and 19 are the remaining units. They don't take me that long to cover. We're going to jump in unit 17, see how it works. I mean, it's good. It's a good unit for personal reasons, but for your exam, you're not going to be tested on this a lot. Nor are you going to be tested on unit 19 heavily. A few questions from each one of these units. So unit 17, what is this all about? It says real estate as an investment, and understanding how selling real estate as an investment is a little bit different than just selling a single family property to an individual buyer. And then also selling businesses are different in the sense of a traditional real estate transaction. They're not really conducted in the same way when you're selling a business versus selling a single family house. Let me show you how it works. On page 392, highlight this terminology. Yes, you do have a glossary in the back of your book, and you also have flashcards in the exam prep. I know a couple of you already got the exam prep. Good. Use it as much as possible. So I'll just briefly describe each one, but appreciation is increase in value. Assets are things of value. Cash flow is the spendable income of a business. They give you an example of this and might be how you're tested. You see, negative cash flow versus positive cash flow might be tested on negative. Anyhow, equity is the difference between what it's worth and what you owe. Leverage is pulling equity out of one asset to purchase another. You're leveraging one to get another. And there is such a thing as positive and negative leverage. And you can read through that later on tonight. Highlight if you wish. See positive, negative leverage here. And on the next page, liquidity, page 393, is what you can sell it for rapidly without loss of capital. Basis is your initial cost for the investment. Capital gains, capital losses, we talked about that in unit 18. And real estate is recognized as a tax shelter because we're protected from taxation through the use of deductions. And we saw all those wonderful deductions that we can claim. Have you ever heard of a REIT? A real estate investment trust? It's like a hedge fund. Do you know what a hedge fund is? Publicly traded company. They collect money from investors because they have the expertise and know what stocks to buy, and they promise an average rate of return to the investors that purchase their stock, and they pay out dividends. It's similar to that. They collect money from investors. It's publicly traded. It's in the stock market, but they use your money not to buy more stock, but they use it to buy real estate. They're basically crowdfunding real estate investments. So they go after huge investments, apartment buildings, shopping centers, shopping malls, office buildings, and so forth. The benefit of investing in a REIT is your liquidity of capital. And I'm going to try to see if I can find that. REITs are attractive because they offer diversification and liquidity. If you invest in a REIT, you're buying stock. You can sell your stock at any time. If you buy the real estate yourself as an investor, rather than utilizing this, when can you get your money out of the investment? By selling it, or gradually over time by renting it. So your money is not liquid if you just buy real estate yourself, unless you invest in a REIT. And risk. There is a level of risk associated with any investment. It's a chance of losing all or a part of your investment, but no risk, no what? No reward. Call me a serial optimist. Go to page 395. There's this property, there's this duplex that I'm trying to buy in Lakeland. And this duplex, I went to go check it out because you have to go take a look at the property before you purchase it. Pictures are okay, but you got to see it in person. So you got to have boots on the ground. I went over there, and I speak with the tenants, and I say, hey, listen, if you could repair something in the property, what would you repair? Like if you can improve anything in the property, what would you improve? And she told me, well, the sinkhole in the back. I'm like, okay, show me the sinkhole. So I went back there, and there's this big depression in the land, and it's about 5 foot wide, maybe 4 feet deep. And I'm like, okay, what's going on here? So I contacted the agent it's a wholesaler that promoted the property. And I say, hey, listen, I'm not going to buy this if there's a sinkhole. Not going to wait. So the owner has to get a report. It's a geotechnical report to make sure there's not a sinkhole and it's not expanding and it's not going to engulf the whole house. Anyhow, they said they're going to reimburse me for that expense and so forth. I hired somebody, they went out and they probed and they found that it's not a sinkhole. It's not a sinkhole. It's just it was a storm drain pipe that burst and it caused that depression. So there's risk. There's risk associated with property, but you got to do the proper research. And there's always people that are going to be pessimistic. You know, these people, maybe they exist in your life, and you actually got to separate yourself from those people. For instance, I told you my cousin is a geologist. I mentioned that before. And I went to him first. I said, hey, listen, there's this property. I think there's might be a sinkhole. There's a depression. I want to find out if it is a sinkhole. And he's such a pessimistic person. He is. So he's like, oh yeah, I would stay away from that. Yeah, don't even waste your time with that. I just move on and look for another property. Found out it wasn't a sinkhole. So if I would have listened to that person, then I would have missed out on it's a great deal for this duplex. Great deal for the duplex. But if you listen to these pessimistic people, you miss out on opportunities. So be an optimist, and opportunities will become more abundant to you. And those types of people, unfortunately, they're going to live their life and they're going to reach a certain level and they're going to stay at that level. You see something different for you in your lives. So sometimes it's the people that are closest to you that are the cause of a lot of negativity that exists in your life. It's really hard to hear that. It is really hard to hear that. Could be your spouse, could be your partner. And you have to change that immediately. Otherwise, it's a toxic environment. I don't want to get too deep into it and be like this relationship psychologist with you guys. But in real estate, it's one of those jobs. It's a people business. You have to be an optimist. You have to take advantage of opportunities. It's the opportunity business. And if you have somebody in your ear that's saying, oh man, transactions, they fall apart all the time. And you can put on your cape sometimes and save the deal. But if you're wired in a way where you're thinking, okay, something, yeah, and you'll give up immediately because of something negative. You have to be clever and you have to work on your toes because you never know how you can save a lot of these deals. Yeah, that's all I'll say about that based on personal experience. But Go to we're on page 395. Advantages versus disadvantages of investing in real estate. Let's go through the advantages. Good rate of return. That's if the market is good. And if you buy correctly. By the way, let me share something with you. The investment is made when you purchase it, not when you sell it, not when you rent it out. You have to buy correctly. You can't get emotional. You can't overpay. You might get lucky sometimes, and then you look like a genius because the market went up in that area. That's a gut feeling, and I would say stick with your gut feeling. However, you have to pay the right price for the property. You don't want to overspend. Anyhow, tax advantages, tons of tax advantages. That's one of the best parts of investing in real estate. It's a good hedge against inflation, which means if you leave the money in your bank account, every year because of inflation, you can buy less and less with that $1 bill. Next year, you think you can buy a banana with that $1 bill. Now the banana is $1.20 instead of 99 cents. That's inflation. So if you invest money in real estate, what tends to happen to that asset? It typically appreciates in value. That's the trend at least, but you have to buy right. Leverage. The only way that you can utilize leverage is because of equity, which is a benefit. If properties increase in value, remember, equity is the difference between what it's worth and what you owe. So the more equity you have, the more flexibility you have to make other investments, because you can pull out the equity in that one property to purchase another. And that's all an advantage. Disadvantages: lack of liquidity. Unless you invest in a REIT, real estate investment trust. More localized market. Do you remember during the craziness when interest rates were low and people are fighting over properties, and these companies out of Silicon Valley, they started making instant offers for people's homes, Open Door, Zillow offers, whatever, Purple Bricks. There's a whole bunch of these companies. A lot of those companies, they stopped doing it, and they got their shirt handed back to them because they're sitting behind a desk and they're using algorithms to figure out what that property is worth, but they don't realize real estate is a very localized market. Yeah, that property across the street sold for $1 million. So they're thinking, oh, this property right here is worth $1 million. It's across the street. And across the street, that area looks completely different. And they're still within close proximity. So they're using this data thinking that they're beating the system and gaming the system, but they're just a whole bunch of nerds that are behind a computer that don't actually know that you have to have boots on the ground. That's how, and they all got their shirt handed back to them. They lost a lot of money, hundreds of millions of dollars. Expenses associated with expertise. Well, if you don't have the expertise, you got to hire somebody. Like property managers, right? They don't work for free. And relatively high degree of risk if you don't know what you're doing. We learned in 2008 that the real estate market is a bubble. Everything is a bubble. But you have to buy correctly. I'm not overspending for that duplex in Lakeland. I'm buying it with equity built in. But another reason why I'm willing to pay a little bit closer towards market value is because they already have tenants inside paying rent every single month. So as soon as I buy it, it's cash flow. And that's what I'm looking for, cash flow properties. So it's worth X amount of dollars to me for that reason, and it mitigates the risk because I know if I buy it, I'm not going to have to search for tenants. I got tenants in place. Let's move on. I want you to skip over to the bottom of page 397, and you're going to see figure 17.2. When you're selling or you're doing a traditional real estate transaction versus like selling a business, it's different. You should be familiar with the similarities and differences. Let's go through it, starting with the similarities. Obviously, you could be selling real property, or a lease could be involved. when you're selling a business or renting a business or whatever the case may be. Not renting a business, selling a business. It could be under a lease. And you need an active real estate license to do both. You remember? If you're going to help somebody buy, sell, lease their business, whatever they buy, sell, lease, you need a real estate license, active real estate license. I want to mention something to you. When you're selling a business, there might not be any real estate included with the transaction. So you're thinking, okay, if there's no real estate involved, do you need a real estate license? Yes. In the state of Florida, even if no real estate is involved, you still need a real estate license to make money off that deal. And that's through intangible assets such as goodwill. And I told you we would come back to this going concern value. You'll see it above. Goodwill is loyalty of customers and reputation of a business. These are intangible assets. These are not things we could touch or feel. You can't touch loyalty. You can't, I mean, maybe you can feel it like emotionally, but you can't, it's not a tangible thing. But does it have a value? If you have customers that constantly come to your business for that good or service, does that have value? If a company has a horrible reputation, is that going to affect the value when it's being sold? Versus a company that has a stellar reputation, of course, must be included into the price. And then we see going concern value. Going concern value is the value of an established business. You'll see this on line 25, compared with the value of a business that has yet to be established. Established businesses are more valuable. You understand why, right? If it's a new business, they haven't figured it out yet. Unless it's a franchise, and franchises are established, okay? They have systems, and you buy into a system that makes it successful. So I'll give you an example. You tell me what you think about it. Mom and pop New York style pizza is for sale, and a Papa John's franchise is for sale. Which one has more value? Doesn't matter your affinity for New York style pizza, okay? We know that Papa John's is going to bring more value because of what we just got done discussing. It's established. People expect to go there for a certain quality of good and service. It's easier to keep it going concern value. And when you're selling a business, it doesn't have to be tied to a specific location always. I mean, pizza shops, yes. Laundromats, yes. Salons, yes. But if you're selling a software company, you could have global appeal. That's what we see here. When you're selling a business, you can have a wider geographical market. When you're selling a single family house, it's that area that dictates what you can sell it for. Situs, S-I-T-U-S, if you remember that. All right, business accounting. I'm going to show you something right here. This is the last thing for this unit. You're going to like this, Cisco. When you're selling a business, you have to have two other professionals involved in the transaction. This is my personal advice. I always have these other two professionals involved. If the seller doesn't already have them in place, I'll make sure that I find those individuals to be involved. So not only am I going to be involved as a licensed real estate agent to list their business for them, but I will require them, if they don't already have one, to have a CPA to prepare the financials, because you know the buyer is going to ask for them. If I'm going to buy that business, then I need to know what the financials look like. So before you list it, those have to be prepared so you're ready if they want to make an offer. And then also I'll have a lawyer involved. And the lawyer is going to transfer all the intellectual property associated with the business. The branding, the logos, the business entities, LLCs, corporations, everything, the licensing, transferring all of that. Once again, if they don't already have those individuals involved. Have you ever seen the TV show Shark Tank? Yeah. And most people enjoy watching this show because we love to see those wonderful business ideas the entrepreneurs present. And sometimes you see those ideas and you're thinking, man, I would buy that. If that's on the shelf, I'm going to buy it regardless. What they're presenting verbally on camera, which is good TV, what people like to see is the income statement. Income statement for the business. So that's just comparing a company's income and expenses over a stated time period. We generated X amount over X time period. That's all it is. That's the income statement. And I had a couple of friends that presented in Shark Tank. One of them got a deal. And they told me before going on the show, they have to prepare not only the income statement in their pitch, but a balance sheet, which tells you the company's complete financial position. And it not only presents the income statement, but also the assets, the liabilities, and the owner's equity. So it tells you everything you need to know about that business, financially speaking, to make an informed decision as to whether or not you want to buy it. And this could get very complicated. Imagine if you're selling, I don't know, a furniture store. Furniture store, you're thinking, okay, just, put a price on it and then sell it for whatever you think it's worth. No, it could be more complex. Yeah, is there inventory? Right? How much inventory? If we sell out all your inventory, how much money would we make? How often are you turning over inventory? Let me tell me about your payroll. Tell me about, are you making the furniture? Are you manufacturing? Or are you buying wholesale and selling at retail? What does that look like? What's the shipping expense? Are you shipping it to the consumer, or are you use a third party for it? Because you have a showroom and people buy from the showroom and so forth. Oh, you're shipping it? Okay, so what about the trucks? Do you own the trucks or are you leasing the trucks? What does that look like? Exactly. So there's so many things that could go into it. And I can go on and on. And a lot of those deals that get done on Shark Tank where they're celebrating, yeah, and you're thinking, oh man, I can't wait until that's available because I want to buy it. 40% of those deals fall apart. And the reason why is because the balance sheet. It sounds really good by their pitch and their verbal income statement, but when they look at the real financials, they're like, no, I don't know. And the show has gotten boring over the years because those sharks, the main ones, they've invested so much into all these businesses that they're tapped out. They have a little bit of money left over and they have to be strategic on the next investment that they make. They can't take as much risk as when the show first began. So now they're like not doing as many deals. They're scrutinizing. And that's why it was a good idea to bring like guest sharks in, because they have fresh eyes and they're willing to take more risk and so forth. And go to page 400. Here are the 12 typical steps that you would go through in order to sell a business. 12 typical steps. You don't have to memorize everything, but you could just review if you wish. It's pretty straightforward. Okay. And here's the thing. Unit 19 only takes me about 10, 15 minutes to cover. So it's up to you. Anybody need a break? Let me know. All right, let's take a break. It's got to be consensus. Everybody's got to be on the same page. Don't feel bad. I mean, we're at break time, so I'm just giving you the option. All right, so be back 10 minutes. 10 minutes. 12:20. Property group, textbook purchase, okay. Okay, morning boss, I reviewed the transactions. Like, take okay. See. Okay. No, it's not what it's worth. Get out of here. No, Outdora. Okay. I take a look at that later. Definitely not that. Definitely not that. Okay. Got about 4 minutes. Let me just make sure everybody is back online. No, not yet. All right, so we'll give it a few more minutes and then we'll continue.
Hey, Michael. I don't know if you can hear us. We can't hear you.
That helps.
There we
Thank
go.
you. Let me know. Let me know if you hear any disturbance or it's not coming through, but I appreciate it. So I'm just telling you the most important parts of this unit, the parts you obviously need to know about to protect yourself and others within real estate transactions and what you're going to be tested on for exam purposes. So what we discussed prior was the government has this philosophy of laissez-faire. It means let alone, let it be. They let us run our businesses the way we want to. Of course, we're taxed, but beyond that, we have flexibility. It's not like a communist country. On page 431, we'll come back to this, but local governments, municipalities, counties establish development goals called by creating a comprehensive plan, plans for the future on what that city or county should look like. We'll come back to that. But on page 432, we see the City Planning Commission, which we actually discussed on the first day of this course. The local
I can't hear anything, Michael. I don't know if the rest of the team can.
Yeah, it just went out again.
Hear me now? Can you hear me?
I can. Yes.
All right, cool.
So can I. Yep.
All right, so the City Planning Commission has control over three things: subdivision plat approval, the plat map, site plan approval, and the actual signage for the entrance of the subdivision, which is interesting. Let's actually continue on to go to page 433. Highlight this. You are going to be tested on this for a class exam question. However, it's something that we already saw in actually unit 10. We have to know the measurement conversion from acres to square feet. How many old ladies? How many old ladies? 4 ladies are driving how fast? 35. In what zone? 60 zone. If you know that, you'll be fine. Go to page 434. Line 3, follow along. Zoning ordinances are local laws that implement the comprehensive plan that we talked about earlier. And we know that police power represents the broadest power of the government to limit the rights of property owners. They enforce. But there's different zoning classifications, like residential zoning. Commercial. But let's talk about residential real quick. Residential zoning controls density. This is what we describe or use to describe the number of homes that can be constructed per acre. When you construct an apartment building, obviously that's higher density than where you see these areas that say, oh, you can only build up to 1 house per acre, for instance. It basically tells you what can be built and where it can be built. That's what zoning is. Commercial zoning regulates intensity of use, meaning that even though it's zoned commercial, you can't put whatever type of business you want in that space. Local government limits what types of business can operate in specific areas. Even though it's zoned commercial, you're thinking commercial, can I just do whatever I want? It's for the same reason you can't construct a school or a church or a liquor store or a gun store wherever you want. You need to know what a buffer zone is. Strip of land used specifically to divide one land use from another. I want you to pay attention next time you drive by like a public shopping center, because you're probably going to see some type of subdivision, a community of homes located behind it. But if you pay attention closely, you'll notice between the commercial property, the shopping center, and the neighborhood, there's usually an undeveloped strip of land. And we describe this as a buffer zone, but what is it used to buffer against? What does that shopping center bring to that area that you don't want to see in a subdivision? Traffic, population, pollution, noise, and you want to keep those separate. So that's why this exists. All right, let's move on. Go to building codes on line 38. Building codes. What's the whole purpose of building codes? To prevent inferior construction practices, right? Quality of construction, workmanship, and so forth. And this covers all aspects, all systems within the home. HVAC, electrical, plumbing. That's why they say, is it up to code? Have you ever heard of that before? It's structurally sound. A lot of people, they do work on the property without pulling permits. They enclose the patio in the backyard and think they can just hire their cousin that's a handyman to do it. But no, anything structural requires a permit. And that's what we need to know. If you go to the next page, on line 14, local governments enforce building codes, but how do they do it? By issuing what? Building permits after they review your architectural and engineering drawings. Now you have to provide plans prepared by a licensed professional. They have to stamp it, sign off on it that says, this is how you have to construct it to make sure it's structurally sound. Yes, both. Yeah. Sometimes, depending on the county or the city, they might ask you to pull a permit to replace drywall. Yes. It's called the drywall permit. I've encountered this. I started renovating this property, and then somebody from the county came in and shut me down. They put a stop, they gave me a stop order. And they say, you have to pull a permit before you replace any of this drywall. I said, it's drywall. What are we talking about here? Just said, I mean, I can do this. I can watch a YouTube video and figure it out. It has nothing to do with the structural integrity of the property. They say, regardless, we require it. So until you pull the permit, you can't do any more work on this property. It shut down my renovations completely. And it took 2-3 weeks to get the permit for it. It happens in the business. So yeah, it could be internal. You want to add a bathroom. It's another example. Some people, what they do is, what about the people that turn their garage into a bedroom? Same thing. Now, some people try to work around the rules. And if you tie it into the ceiling, it becomes structural. So what sometimes people do is when they build out they change their garage into a room, they basically, they build a structure that goes right up to the ceiling and stops there. So they don't have to tie it in and pull a permit for it. Interesting. Let's move on. Go to page 436. If you want to get permission to do something with your property that it's not zoned for or limited from doing, you have to request a variance. You have to submit something called a variance application. Okay, at one of my properties, a water heater went out. God bless you. Tenants didn't have water. Crew go out to replace it the same day. The township, yes. To replace the water heater, you needed a permit for it. Wow. Yeah.
That is.
I mean, imagine you're a tenant inside of it, and they're going to be just as frustrated as the owner that's trying to mediate, right? Trying to fix the issue. That's wild. Anyhow,
Yeah,
that's
they
like an
stopped. They
appliance.
stopped him from getting water. I was like, how does this make any sense?
You know, up north, here it would be ridiculous. Up north, a lot of the water heaters are gas powered, right?
Yes.
Yeah, propane powered.
Mm-hmm.
And that's a delicate thing too. So I kind of, you know, like I want to play devil's advocate real quick. I kind of see why you don't want people messing around with gas lines in the house. You want somebody that's a licensed professional to do it. And then, but the permit thing, you know,
Yeah.
I guess they want to make sure a licensed professional is doing it. So they say, come to us, get the permit, then we'll go check to make sure a licensed professional actually did it and not like a handyman that you hired
Hmm.
that was on the side of the road, you know? So, I kind of understand where they're coming from, but
That's,
yeah, that would be wild. You gotta have to have temporary space heaters and all kind. But then what about the water? I mean, you still, what are you gonna boil water? Like, it's gonna be wild. So I can't even imagine living up north in ice cold winter and not being able to replace your water heater when you want to. Anyhow, how did they find out?
They were driving by. It was awful luck. And they just called me. They're like, hey, we see a crew working inside your house. Do you have permits? And I was like, they're replacing my hot water heater. My tenants don't have water today. You know? And they're like, well, you need to stop. You need to pull a permit. And I was like, wait.
Yeah.
I just clarified. I was like, wait, so I need to delay my tenants getting water? So
How
Yeah.
long did it take?
the next day, the next
Oh,
day.
okay. All right. So they're
Yeah.
pretty quick with it then. That makes sense.
Yeah. Yeah.
They just want to
So
make sure that a licensed professional is doing it. That's what's going on.
yeah, and so what I gather, Michael, is it sounds like hot water heaters in Florida are commonly powered by electric.
Yes. Most.
Oh, okay. Most. And are most tank or tankless?
Most people do tank.
Okay.
I've
Interesting.
owned property that I've had tankless in my house. And if you do tankless with propane, it's like the best combination, the most
Mm.
efficient thing you can get. But that's just not a common thing here.
Interesting.
And then also when you do tankless and you have hard water,
Hmm.
that the longevity of that system, it just doesn't last.
Hmm.
So you have to pair, if you do it here, if you do electric tankless water heater, which basically the water passes through coils and it rapidly heats it, you have to have like a soft water system as well, water softening system. Yeah, exactly. If you go to page 437, focus on this right here. Okay. Legally non-conforming uses. I don't know if you've driven down like downtown Orlando before. Have you ever driven? Okay. What about downtown Kissimmee, maybe? Downtown Windermere, Winter Garden? And you see something that looks like a house, but it's a law office, a medical practice. And you're like, what's going on here? Did they have to leave it looking like a house? Is that a requirement to be downtown? No, it used to be a house. It used to be somebody's residence.
We can't hear you again, Michael.
I mean, both of them go out. All right. Can you hear me?
Yes.
Yes. All right, cool. I'm just going to use a built-in microphone. Less clear, but anyhow, you'll be able to hear me. So once again, the area used to be residential zoning or allowed residential, but then commercial zoning took over. You can imagine skyscrapers are built and all these things. The city expanded to commercial zoning. They can't push you out. It's part of our Florida Constitution. You'll see that, or the U.S. Constitution online 6. They can't force you to start using it as commercial because you're grandfathered in. Have you ever heard of this before? You existed before zoning had changed. And that's where the name comes from. You're legally not conforming, not complying with what it's now supposed to be used or zoned for. Any questions? But if you switch and start using it as commercial, you can't go back. You can sell it as residential, and the next owner can use it as residential. But as soon as they change it, start using it for commercial purposes, which is the current zoning, can't go back. Because that's what they wanted. They say this area is commercial now. You're grandfathered in. We won't force you, but if you switch, that's what it is. If we go to environmental hazards associated with real estate, go to page 440. In that previous section, I'm just going to mention something that we skipped over. flood insurance? Because Florida is so flat. Essentially, everywhere is a flood zone in the state of Florida. It's just more or less risky depending on the classification of flood zone it is. If it's like the A through E flood zone, high risk of flooding, versus X, which is less likely to flood. And this could trigger the borrower, to purchase flood insurance. The lender might require this. Let's talk about what we have in front of us on page 440, asbestos. This is the last portion of this unit. Do you know what asbestos is? It's a fiber material, and it was added to building materials before we knew it caused cancer because it was flame resistant. They call it flame retardant. You'll see that right here, fire retardant. So that means if you try to set fire to it, it would not catch. So builders, manufacturers of building materials started adding it to everything: shingles, drop ceilings, flooring, adhesive, drywall. They added it to everything because they're thinking the dream is we can build a wood house that won't burn if we add this wonderful, miraculous material to it. But what they found out is the fibers, once it enters the system, inhaled, it's a fibrous material, it causes cancer. You'll see that here. Inhaling this microscopic asbestos fiber causes cancer in the chest cavity. And it's very, very common for homes built prior to 1978. Radon gas. We already talked about this in a previous unit. Chapter 4 of the 404 of the Florida statutes requires that you include a disclosure in your sale contract explaining the hazards of radon gas. You're not saying I'm going to test it for you. You're not saying I'm going to resolve the matter. You're just saying here are the hazards, so you know. It's an odorless and tasteless, naturally occurring radioactive gas. We already talked about it. Let's move on. We also talked about lead-based paint. You remember this? Common for homes built prior to 1978. And you have to provide disclosure when you're selling or renting of the hazards of lead-based paint. You're not fixing it. You're not removing it. You're just saying, here are the hazards. Mold. Go to page 441. Not all mold is going to kill you. Not all mold is hazardous. But here's the thing. If you have a mold problem in the house, you know, right? When you enter the house, you know that mildew smell. It's very familiar to us. And you go into the house, you're thinking, what does that smell? It's like a mildewy smell. It's coming from somewhere. You check all the wet areas. You check the HVAC system. You check under all the sinks in the cabinetry. Check the water heater. And here in Florida, mold thrives because we have a very humid climate. And it spreads easily and it could cause very serious risk. So you can't mess around with water issues in the home. You have to address it immediately. And that's why even Abby was telling me about the tenants and so forth. She didn't mess around. She knew, like, hey, listen, water heater goes out, water issues, whatever the case may be, I got to be on it as soon as possible. If there's a leak in the house and the tenant tells you, don't waste any time. Don't lollygag with this stuff because it could become worse easily. There's devices you can buy on Amazon and put it in your house, test the air quality, and use it for negotiation. You say, hey, listen, there's a high mold content. You can get them to fix the air quality within the house. There's companies that offer that service. Water supply, you have to disclose this to the prospective buyer. Where is the water coming from? Is it public utilities or is it a well? And when people think about a well, they think about this big stone structure, 6 foot wide, with the lady from The Ring falling out of it or something like that. In Florida, a well is like 2-3 inch, 1-2 inch pipe that you put 20 to 40 feet beneath the ground, because if you dig far enough, you hit water, right? But this water that you pull from the ground is typically not potable. It's not drinkable. It has to be processed. And if you notice houses that have orange, yellowish orange staining on the sidewalks, on the side of the house, on the fences, and you're like, why is that a thing in Florida? All these houses with orange. It's because rather than paying the city or county to water their grass using the water from that they provide, you can pull it from the ground and it saves you a ton of money. Water and sewer as well. They'll charge you for both if you use the city, if you use processed water. So that's, and it has, that water from the ground is rich in iron and sulfur. That's why it smells like eggs when people are watering or irrigating their grass. It's not sewer water that they're using, even though it would probably be really good for the plants. Sewer water, right? All the nutrients. Has no nutrients. But yes, the water from the ground is good for the plants as well. Iron and all the minerals from underneath the ground. It's really great, but it does stain unless you process before spreading. And then also septic system for sewer. Are you familiar with, have you ever lived a property where there's a septic system? Yeah, these systems are delicate. There's something called a tank and a drain field. So the tank fills up with all the wastewater. I'll let you use your imagination. And you put chemicals in it. So the solids decompose. You know what the solids are. And then the liquids go through the drain field, get distributed throughout a drain field. This is how it works. And then you have to get it pumped every 6 months, whatever the case may be. These systems are delicate. Those flushable wipes are not so flushable anymore, okay? Really, they're not flushable in general, but definitely not for a septic system. And even toilet paper, really you want to try to avoid putting toilet paper, you want to put it in a bin versus flushing it down the toilet because it all builds up in the system and it could cause serious problems. And what happens is if the system backs up, it kicks in reverse. And all that poo water comes through every single drain in the home. The faucets, the drains, everywhere. All that poo water comes oozing out. Lovely.
I have a horror story about that one.
As well, my sister does, and but yes, you want to share?
Oh, it's a long story, but yeah.
Did you know there was a set, or did you know about septic systems and all that stuff before you got into it?
We knew about the septic system, and let's say we weren't fully disclosed about certain details about the state of the septic system. So 2 weeks after moving in, everything backed up and flooded in the house. It was a nightmare.
And if it wasn't pumped before you moving in, that's not your poo.
No, no, it wasn't.
Yeah, same thing happened to my sister. She didn't know, and she was flushing these, those flushable wipes down the toilet, and I'm like, you can't do that. You're on a septic system. It was the only house in the neighborhood on a septic system in Winter Park. Yeah, it was this one house that held out, didn't want to pay to run the line to them. But anyhow, she didn't know, and she never lived in the house. And I said, you can't. These systems are delicate. She didn't know. She kept on doing it, and then I get this random call like 11 p.m. screaming like, "There's poo everywhere!" Yeah, so it was bad. And WDO, wood destroying organisms. What's the first thing that comes to your mind? Termites. That's not the only insect that will eat through the wood in your home. In Florida, we're humid. Insects thrive. Yeah, there's carpenter ants, there's wood boring beetles, there's 3 or 4 different kinds of termites that exist, and all of them are looking to destroy the framing in your home. Yeah, so as an investment, I won't buy a wood frame house. Maybe if it was constructed after the 2000s. But other than that, I'm not going to take a risk. I'm just not. Because anything prior to that, I can almost guarantee there's some type of termite infestation or previous infestation, unless you can show me you've consistently gotten the house treated. But that's just few and far between. People don't think about it until the floor starts caving in. Anyhow, WDO, wood destroying organisms also include wood destroying fungus. That's a thing, and that exists in Florida. So you see like wood rotting out on the side of the house or in the soffits or in the floor. It might not be termites. It might be maybe a lot of water intrusion over the years and they didn't take care of it. Maybe they fixed it, but they didn't take care of it and it caused mold, caused fungus. They ate through the wood and then you're left with a hole. It happens. Any questions here? We're actually done with this unit, which means we're done with the textbook. Clap it up for yourselves. We did it. Awesome. I mentioned I was going to go through some things with you before you left, and that is that 5-step guide. So let's go through it right now. Any of these work?
Just the-
There you go. All right, this is in front of us, right?
Yes.
5-step guide. Let's go through this together. Oops. Here we go. The steps towards obtaining your license, and a lot of these steps we've already completed, such as step number 1, complete the pre-license course. Clap it up for yourselves. All right. Unless you have to make up missed classes, you know what it takes to make up missed classes. Either you could do it in person, not in person, online through the next class, or you can just get the videos. You have access to get those. Fingerprinting. Who's actually submitted their fingerprints? Who's done it? One of us? Nobody else. Okay.
Everyone online did.
Okay, everybody online
We're
did
good.
good.
Yeah.
In person, we got to step it up. We have to submit fingerprints for your level 2 background check. Buy it today. You'll get the link. You'll have access. You can go to a nearby fingerprinting facility, get it done. They will not touch your application until you get that done. And then you'll set yourself up for getting approved to take your state exam. That's part of this process. You'll see it here.
Hey,
After
Michael,
you
quick
s-
question.
Yes.
On like after the fingerprinting, I guess the background check, that just happens on the back end, right? Like we don't have
Yeah,
to.
you don't get any copy of that.
Okay.
And they don't expect you to do anything with it. If you use the link, if you buy through us, it's
Yeah.
it's a 1-step process. It goes directly to DBEPR, the Florida Licensing Authority.
Okay.
They will have a copy of it. You don't get a copy of it, but you know that it's done. You've completed that step.
Okay.
And then wait 24 hours to submit the application. Application is done on DBEPR's website, myfloridalicense.com. It's right here. And I've already walked you through all the steps. I even took you online, correct?
Yep.
Here are the steps. Follow these from the homepage. You can easily knock it out. Any questions about this? The application and fingerprints, once processed and you get that eligibility email, is good for, or valid for how long? 2 years, plenty of time. Cameron Academy exam. You're taking it online. You have access through your dashboard. You might have noticed this. If you clicked on final exam, you couldn't access it because it's not available to access once we're done with class. It will unlock and then you can take it. You have 30 days to take it. Make up any missed classes and then take your final exam. So when does the 30 days start? From the 20th, last week, Monday. And you have by February 19th to wrap up everything with us. How long do we give you to complete? It's timed. It's 3 hours. It's not from us. If it was up to me, I'd give you more time. I don't care. I mean, but the state requires that it's a 3-hour test. There's plenty of time. Most people finish in under 2 hours. If you finish early, keep your butt in that seat for the full 3 hours and review. Review. Use all the time that we give you. Same thing for the state exam. State exam gives you how many hours? 3.5 hours to complete. You have maximum how many attempts? 2 attempts. Your passing grade on your first attempt, which should be your only attempt, 70% or higher. If you don't pass, you have to wait 30 days for your second attempt. You have up to a year, but you have to wait for 30 days to pass, and now you have to get what grade? If you don't pass on your second attempt, you got to retake the course. I'll see you right back here. Don't let it happen to you, please. Once you pass, your certificate will automatically be added to your dashboard. You'll notice under the certificates tab or whatever, it says 0 because you haven't passed the class exam. But once you pass, you'll see 1. And it populates all of the information you provided to us upon registration. So complete your registration form completely. Fill out everything. Yes, we need the last 4 of your social. It goes on your certificate that you bring with you to the state testing facility to ask you for a copy that we issue. And the certificate is good for 2 years. State exam, as we can see, you schedule your state exam through Pearson VUE. Pearson VUE is the name of the national testing vendor. But the only way that you can schedule through Pearson VUE is when your application and fingerprints have been approved. They send you via email a 9-digit code. They say, congratulations, your application is approved. You are eligible to take the state exam. Here's your 9-digit code. That allows you to go on pearsonvue.com, plug in that code, make an account for yourself, and schedule the state exam. When you go to the state exam, they're going to ask you for 2 forms of signature identification, right? Signature ID, passport, driver's license, even a debit card with your signature on it, and a copy of the certificate we issue when you pass the class exam. They give you 3.5 hours. Your passing grade always
Is it 7?
needs to be 75% or higher. Okay. You do receive your results at the testing facility. Passes aren't graded, only fails. So if you don't pass, which you should pass on your first attempt, but don't feel bad if you don't. It's not the worst thing in the world. The best of us have not passed on our first attempt. I know it's a lot to retain, but you have to put forth the effort. I know you want to pass on your first attempt, but it's up to you. Nobody's going to take that exam for you. Nobody's going to study for you. So how well do you prepare yourself by going through this material, the highlights you've been making, the practice questions? The exam prep is going to help you out. It has audio files, hundreds of practice questions, answers, and explanations for each one. Math videos are there, puzzles, quizzes, everything you can imagine. If you don't pass, you have to wait 24 hours to reschedule, and every time it requires a fee. They allow you to pay to review the test you failed. You get an hour and a half to review the test you failed, and that has to be done within 21 days of the fail date. And once you pass, you technically have a license, but you can't practice real estate until you make your license
It's a full-on-
active. It's going to be voluntary inactive until you find an employer, either a broker, like a real estate brokerage company, like Cameron Realty, Keller Williams, whatever, or an owner developer. And when you pass your state exam, what's the next thing you should think about? Come right back and do your post. Then you never have to do that post licensing again. And we know it's the most important renewal. If you're late by 1 day, you lose your license. You have to start all over again. Don't let it happen to you. The sooner you do the education, the better it is for you. Gives you that peace of mind. We report your hours to the state. It stays on file with them. And then when they ask you to pay your renewal fee, it's as simple as logging in and paying with a credit card. The education takes a little bit of time. So do it early. Every renewal after that is a 14-hour CE, piece of cake. Any questions about this?
How long after passing the state exam does it take for the state to issue the license?
Like 24 hours.
Oh, wow. Okay.
It was all paperwork. It'd be.
They email it to you. So you pass that state exam, Pearson VUE reports that same day or by the end of the day, everybody that took the exam with them, and then usually within, they tell you it's going to take a little bit more time, but usually it's about 24 hours.
Then you gotta make your own card.
And then you print it out, keep it on you as prima facie evidence. Any questions for me? I'm going to miss you guys.
Do you mind if I take the stage just for a second to remind everyone of the study group today?
Yeah, of course.
Okay. Just want to make sure that everyone online also got the text as well.
Yeah.
So.
Here.
All right. I don't know if everyone got the text from me about this Thursday. If you didn't, speak up now and I can add you to that group chat or send you the information, but we're gonna hold the Zoom for chapter 10 and as much of the math that we can get through tonight. So are you guys online aware of this or on the text chain by any chance? Do you perceive that?
I saw it. I think I responded too.
All right. What about you, Bob? Where did you?
Yep, received it. I won't be able to participate though.
All right, that's all right. I just want to make sure that you guys were
No,
aware
no,
of
I
it.
mean, I appreciate it.
We're
Yeah.
getting information. All right, perfect. All right, then. Well, I already talked to pretty much everyone else individually. I'll see you tonight at 7 o'clock.
I love that.
Zoom. We're gonna do that, and then we're gonna study again on the weekend for the big old test, and then we should be all set. And then from there, it's just state. So study, work hard, and we'll all get it.
Awesome.
So-
Thank you, Dawson. Thank you. Very motivational. And it's the effort, right? So you got to make the effort. You want to pass, get your license as soon as possible. You're better off having the license than not. We have two traditions here at Cameron Academy when we complete a class. Number one, we're going to take a graduation photo together. I'm sorry, you can't sneak out. I see you guys already grabbing your keys. Stop it. So that's number one. I'm going to take a nice little graduation photo. See if I can get participants here. Okay, maybe they changed the format here. Not sharing my screen anymore. Wish I could expand this. Oh, okay, there we go. Cool. All right, camera's on, guys. You guys can stay exactly where you are because I'm just gonna take a photo this way. Arise. Arise. Come to the front. Push in your chair, Dawson. And then let everybody scoot in this row, just in this space, in the first row. So we can get together. I'm gonna take a photo this way, all of you. All right. Here we go. All right, so it's the last day of class. Are you guys excited? All right, I want to see the excitement in the photo. On the count of three, I want you guys to say care loud, okay? All right. Why? Why care? Cameron Academy of Real Estate. See? Okay, because we care about you. Anyhow, you ready? 1, 2, 3. Care. All right, come on. Let's that's a little bit stiff, you know? It's the last day of class. Loosen up a little bit more excitement. Ready? 1, 2, 3. Care. It's awesome. I got it. And I have one favor to ask of you guys. Did you guys enjoy class, first of all?
Yeah.
Feel like you learned a lot throughout the 2-week session? That's always our goal, and we want to make sure you have the best experience here. We don't know you're struggling unless you let us know, okay? And we do a good job of fixing any issue that you might have. A lot of you have mentioned some issues you have with the account and so forth. We're on it immediately. We want to make sure you have the best experience possible. Hopefully you've seen that. If you have any concerns or you need help with something, don't hesitate to let us know, okay? We're here to help you out. This is what we do. So please do that. And the favor I ask of you guys is, do you have your cell phone?
Yeah.
Yeah.
Can you help me out with something? Please open up. Anybody a Yelper in here? Anybody like a review on Yelp? Okay, no, it's okay. Can you open up Google Maps?
And add a review.
Yes, please, if you don't mind. Please, please. I'm not asking you for 5 stars, but listen, every review helps the next person that's trying to find us. We've been in the business for a long time. We really care about your opinion, and the review does allow us to get exposure and teach more people with this education that's irreplaceable. So if you have Google Maps specifically, not the maps that come automatically with your iPhone, but Google Maps.
Okay.
I know it's a weird thing to do, but if you go to Google Maps and you search for Cameron Academy, like you're looking for directions, and you tap on the business, you can scroll down and leave a review for us. You can leave, the stars and write something. I appreciate it. It does help us out. tremendously. Yes, we strive to be a 5-star company because we want to make sure people have a 5-star experience. We're doing this a long time. So please. And if you speak another language, I don't mind. Okay. It helps the next person as well. Speak Spanish, you speak Creole, or you speak French or one of these other languages. Yeah, you can write it in a different language. It just looks good. I've had students write reviews in Mandarin and all kinds of stuff. They usually include the translation beneath it, but yeah. And hopefully you stay in touch with us, please. Can you make that promise? When you pass your state exam, can you let me know? Can you at least email me? Is that all right?
Yeah.
Take a selfie of yourself holding the pass notification. And
Michael.
you can email it to Michael@CameronAcademy.com. So my name, Michael@CameronAcademy.com. Yes.
You answered the question. You gave the
Oh,
email.
okay. And then also email me when you get your first deal, your first commission check. And if you're feeling really generous, I like bribes. No, I'm just kidding. But I do wish you the best on behalf of everybody you got to meet and some people you didn't get to meet. We definitely were here for you guys. We wish you the best. We know that you're going to crush it. There's so much opportunity for you. Remember, now is the time to get your license. Now is the time to learn. And when things pick up, springtime is when the real estate market always picks up because you can imagine tax returns. And this might be the last year for tax returns. Who knows what's going on with that? So take advantage of this time, learn, crush it, and please stay in touch with us.
Excuse me.
Yes.
We could take the mortgage license, the mortgage license and the property insurance license right after this, right?
Yes, absolutely. You don't have to wait till you get the real estate license before you start those courses. And at least get that mortgage license. But if you really want to take over, you get the insurance license as well. You get those 3, it's the trifecta. Then there's no downtime for you. You're always going to be busy in this business because if mortgage and real estate slows down, you can make money on the insurance side. If insurance slows down, I mean, they go hand in hand with one another, but you understand what I'm saying. Any questions here? No questions? All right, push your chairs, clean up your mess, drive safe. God bless for the last time. But hopefully, once again, you stay in touch. Let me know when you pass. And it's been my pleasure. Thank you guys so much.
Thanks, Michael.
With my Spanish? Estoy tratando, you know? Muchas gracias. Poco a poco, you know? All right, thank you so much. All right, cheers.
Oh, just to make sure we don't have to log on tomorrow, right?
What was that?
That we don't have to log on tomorrow.